The Wi-Fi cracks out.
Is there like we don't have a timer or anything?
No, I got it. I'm kind of looking on top. Row 103. All right, everybody. Welcome to For Guidance, live at DAS, Digital Asset Summit in London. Excited to be doing this live this time. Joined today by Avi Feldman, 1000X. What's going on, man?
Hey, what's going on? Thanks for having me on the pod. This is always fun. Love listening to you both. So
good day, like a tradition. Yeah, and we got Quinn. Quinn's jumped in for the afternoon, so I'm actually gonna be joined by my compadre, host in chief. So
we ditched Tyler this week, so everything's PG. We can do it live. When you record with Tyler, you can't do live. Some bombs in there. Yeah.
It's kind of fun though.
Yeah. So you gotta have those guys. Yeah. It feels like just like a tradition that we do these at the conferences. So
I know we did it at DAS New York last time.
Yeah.
We had Jonah, but Jonah's busy. He's got 3 kids. I've got 0. So I get to go to London.
The dads are home, and then we're all here.
I get to go to London, have a little fun. Run around.
Yeah. I love it.
See you, Jonah.
Yeah, exactly. Man, so a lot's happened since the last roundup we had. That was sometimes you just get punched in the face, you know.
Yeah, I mean that was one of the most crazy days, not just because of the price action, but because of sort of how I found out about it. Is that I actually like barely noticed because I was off the desk that day, which was a horrible decision, but I had to be. But it was one of those things where I checked the CoinGecko and I went on. It was like, okay, all right, yeah, I see my timeline is full of despair. I see this looks really bad, but things are down like 10-15%. What's going on? And then you go look on TradingView. So I'm okay, something clearly happened. So you go on TradingView and you see these wicks. Yeah. Wicks like I've never seen. I've never seen wicks like this.
COVID without COVID.
Even COVID. Like I distinctly remember trading COVID. I was glued to my desk for 24 hours straight the night of March 12th, 2020. I was glued to my desk. And it was a slow cascade. Bitcoin started at about 7,700 and bottomed out at 3,000. Massive dip, way bigger than this dip. But it was a cascade and you felt like the world was ending. But you also understood kind of what was happening, right? Like, okay, so the NBA just shut down their season. Donald Trump got up there and said that there's this virus that's taking over the world and it's coming from China. And we were sitting there going, okay, this is serious. This time it was just boom.
Yeah.
Right.
One
tweet from Trump. It's always Trump.
Yeah.
One tweet from Trump, and just the market falls apart.
Yeah.
It was,
it was insane. And then you look at the different exchanges too, and the wicks are so different. So obviously it looks like, people have been doing a lot of postmortems on the timeline the last couple of days, trying to figure out what happened. And it seems like a lot of the pain came from Binance. And it was actually an interesting debate I was listening to a couple hours ago at the conference here, and we had Hasib and Jordy Alexander debating this idea of, can synthetic dollars create the next Luna style crash? And they're going both ways. Jordy was arguing that it is going to be the next kind of Luna style crash. Hasib was on the other side of things, and that is more just an idiosyncratic risk on the Binance side, where they did not hard code to tether USDT, whereas something like Aave was hard coded in terms of the USDT.
But only as of recently.
Yeah, only recently.
Very lucky.
Yeah,
very lucky.
Yeah, so that's where a lot of the pain happened. We've learned since that I saw a headline that Binance has since refunded people that got whacked by that USD peg where it was not hard coded. So that seems to be obviously like, my read is that the market was primed, like positioning was stretched. We've seen open interest elevated for a while. And, we were going back and forth on the last couple of roundups, just being like, all right, we can see the macro backdrop, and that's still bullish in my opinion. We can get into this, but it was clear where we were going. It's just, you got to navigate the positioning dynamics. We're trying to do our best, but at the end of the day, you get one really negative out of nowhere Trump tweet. That's what happened.
Yeah. I mean, one thing that I'll say about the stablecoin stuff, is that it's really it's a function of liquidity. What happened on this wick? It's a function of liquidity. It's that at the moment that everything came apart, nobody was there to buy. And so obviously if you have huge amounts of liquidations coming down the pipeline, every buyer is going to wait. So it all happened very quickly. There was a cascade, but it was at the end of the day technical.
Yeah, exactly.
And the positions that were liquidated were mostly delta neutral, actually. A lot of positions like these, whenever you see a tweet out there talking about a market maker blowing up, market makers are delta neutral. So generally, for every long, they'll have a short paired against it. They'll be long Bitcoin, short Zcash or something like that, which would have been a horrible trade that day. But but you know, so what happens is when the market starts collapsing in on itself and there's no liquidity, their long will get liquidated, and that means they'll be uncovered on their short, which means they also have to offload their short. But liquidity is kind of all over the place. What doesn't happen is what happened with Luna. So when Luna collapsed, they had billions of dollars of Bitcoin on their balance sheet that they needed to sell to cover their losses. Market makers don't have huge inventories of just outright long positions to offload on the books. So you don't see this ongoing issue where the market continues to bleed out. You get this one big technical blow up, and then the market works through the liquidations and then reverts to normal, which is why you saw a lot of the more trader guys get on sides over the weekend saying, okay, this is right now a technical sell-off. It could turn into a fundamental sell-off if Trump keeps pushing China, but right now it's not. And that's where I stand even now with Bitcoin. I think it's 114, 115. It's like we're done with whatever happened, in my personal opinion.
Yeah, that was your read. Yeah.
Well, one, it's always a funny observation, these liquidations and sell-offs. I mean, this was insane. I was like yelling at my phone when I was trying to get back to the computer quick enough. But they all feel so grim, and they're always buys. That's one thing that every time there's a different reason in your head or in the narrative that's like why it is, or is this the end of alts forever? And which some it is, obviously, but it's always the buy on these cascades because it's just, like you said, so much technical selling. And even if it was catalyst driven or exploit driven or whatever the ultimate explanation becomes, it's just tons of either forced liquidations or voluntary unwinds of positions that at the end of the day is technical, and we've seen it, the bounce. But my observation when I'm over the weekend as well and in the immediate was I'm watching Bitcoin and it's not even moving. I mean, it's down a couple percent, and I'm like,
quick to like 103 or something, and then it was like we're back.
And we always, I know you talk about on 1000X too. Everybody, crypto participants don't even really own Bitcoin anymore. It's even though it's a top performing asset, it's the ETFs and it's a different market. But so part of it probably has to do with like the average participants just gambling on all this bullshit. But that is incredibly bullish. I mean, this thing went down to the bottom tick on Coinbase was 107 maybe. Like
I think it was like 102 for a second.
And so I'm looking at, and I'm sitting there and it's like, and even over this weekend, I'm like, what do you buy? On the one hand, okay, the safe play is Bitcoin because that is just, it didn't even, it sucked this liquidity at wick December 2024 highs for a second and came back to a higher low. So like one, I'm just like, God, man, that is so bullish Bitcoin. But then you don't get as much of the reversion play as you see some of these alts that were down 30.
You could get levered up.
Yeah, exactly. Yeah. So got wiped out. Get right back in the game. Chief. But
compared to something like Atom, I saw it traded at basically like literally zero.
Yeah.
So that was my biggest takeaway. Was like, I kind of was just, I'm still kind of, because with that level of liquidation, obviously the carnage was in alts, but everybody's cross margined. Everyone's got. You're selling. It's like baby out with the bathwater. It's like in TradFi when there's a big bad day. Everything's the same on a sheet of paper. CUSIP, it gets tossed, so gold's down 1 or 2%. And that's your signal to buy, big sell-offs in traditionals because you're like, okay, if gold got hit, the safe haven.
Yeah.
In this case, it's 100%. Like, holy cow.
Yeah. So I guess the big question now is like you zoom out and you're like, all right, so what's changed since the last time we talked a week ago? And obviously there was for a moment some fundamental changes where we had China coming forth with trying to squeeze the precious metal, the rare metals market situation, and that led to Trump to come forth with 100% tariffs. You're like, okay, that's a fundamental change. But then, as he does by Sunday, it looks like they're trying to off ramp that again. So you got to pair that with being the catalyst and also this fundamental change. But it does look like we're going to walk back a little bit. Big question now is there's that Trump Xi Jinping summit at the end of the month, and you're like, all right, we have this air pocket where they can still escalate and be able to still de-escalate afterwards. So there's still that potential tension, tail risk. But at the same time, like when I look at my macro framework right now, nothing's changed for me. I don't know about you guys. So.
No, nothing's changed, because I think these tariffs, which I aligned with you on, Trump has consistently walked them back, and I think he will continue to consistently walk them back, because the reality is, an actual trade war between the U.S. and China is catastrophic. And Trump, as you can see, I think a lot of this, you just have to understand the guy. He cares so much about his image. I mean, this is why he's trying to go for the Nobel Prize. That's why he's always talking about the stock market, right? He cares a lot about his image, and the one thing that he doesn't want to do is be responsible for some sort of, catastrophic meltdown. Additionally, I think that he understands that the market could be in a precarious spot if earnings start coming back badly. I think everyone sort of understands this. So that's the other side of it, is that I do think, maybe a little contrary to what you guys have discussed, or maybe you agree with it, that we're in a position where if earnings for one company comes back, it's okay. 2, you're looking at a little bit shaky. And 3, you're thinking, okay, so this rapid growth that we've seen from this AI boom, is that unraveling? Let me get out. And so it's really important to see continued growth right now, in a way that it probably wasn't six months ago, when you did have some bad earnings calls. So that's the only other thing I'm nervous about. I'm wondering, what do you guys think about that?
I think they will be okay. I think I agree with you about this patch of a lot of the data I look at, forward-looking economic, and it points to a pretty Goldilocks type environment next year, starting even as soon as January. The government shutdown added a wrinkle to this, because you have nerves, not loud nerves, but nerves around a growth scare and this patch, that is not helpful when they potentially, I've read some pretty credible things that they might use this as even a bigger doge, which is still a risk of like permanent layoffs. So I think that's sort of in the backdrop. And then when you just take Friday's price action, like, we cut through. I mean, it was indiscriminate selling. Crypto started to sell off first, and one of the first things I wrote was, the best trade here, we covered our longs. I was long. It got whacked.
Good move,
but
good move to cover.
But and I didn't put. I was like messaging some buddies. I was like, short Mag 7 here, right when it came down, because that's the other thing here. Why he sort of has to taco is, 40% of our stock market, Mag 7, has 20 to 30% of their revenues from China. So you want to pick a big battle here, sure, but then you're going to take a big hit, and they can't have that. So you have that backstop, and so I thought that was, still think that's area is the most at risk. I actually think like Bitcoin outperforms that going into year end, but navigating this, and I still do think there's an escalatory potential, like, because if you're China, why didn't you turn in the knife here? When you know he's got a
test the runway.
Like, and I do like, I think they do de-escalate ultimately, but you kind of
how do they go first?
On the business from China, that's such a key point. That I'll tell you a story. So my dad's an old school guy. He's an economist. That's where he comes from. And so we're talking about the tariffs, and he's saying, I don't understand. And he's a really smart guy, in my opinion. He goes, I don't understand. How can we have all these massive tariffs, and the market just keeps going up and up and up and up? Somebody's got to pay for it. The consumer's got to pay for it. The government's got to pay for it, or the company's got to pay for it. And the answer is, none of the tariffs affect the things that are driving the market right now. They don't affect the Mag 7. Who cares if Ford comes back? If Ford blows up tomorrow, the market is not down that much, right?
And they probably get bailed out anyways.
Right. So that's sort of the tension here, and that's why the market reacts so forcefully to China tariffs, is because that's the one that matters. The rest of the tariffs, they actually could be net beneficial for us in terms of raising money for the government. And these companies that are getting hurt are not the drivers of the stock market right now.
And then you add in this layer right now of this, you keep hearing about the K-shaped economy, but I think it's really true. I've been saying this recently, and I've been getting some flack for it, but the stock market is the economy, and I truly believe that, because in this K-shaped world, yes, the bottom leg of the K is struggling right now, near recessionary. But the reason why we have higher GDP growth is because asset owners, their stocks keep going up, because the Mag 7 keeps going up, then they keep spending, and then that creates higher GDP growth, and then they keep spending and consuming. So even though, yes, tariffs might hit that lower K, they're not the ones spending and driving GDP growth.
100%.
It's the Ponzi of
Yeah.
equities going higher, giving more income for the rich people to keep spending like crazy. So you just have this continuation. It's insane.
100%. I mean, look, and I'm sure you guys experience this too. I know myself. If I look at my portfolio and it's up a lot, like I'm getting that extra guac.
Yeah.
You know, it's like I'm contributing to the economy a little bit more.
Yeah.
And that's what's really important here, which is why I think he walks it back. But I don't want this bullishness to get misconstrued by the people that are trading meme coins and
And
altcoins,
useless altcoins.
because
Yeah.
I do genuinely think Friday was a turning point for altcoins.
Yeah.
I think that it's going to take a very long time for that exuberance to come back to the markets in the useless stuff. The good stuff, where flows are actually going, are doing really well. Like BNB is doing ridiculously well because Binance is doing well, and I think a lot of it's off the news that Trump's considering, letting CZ operate in the U.S. more
Yeah.
freely, considering pardoning him. I don't know if that was real or not, but the looking at allowing them to have perps in the U.S. was real. They just got a potential investment from China Renaissance Bank for $600 million, and so things are looking up for Binance, and so BNB as a proxy of that is going to get flows, and it could actually turn into an institutional asset, which is, and that's what's happening right now. That because the market's institutionalizing, the stuff that can get big money flows is going to do well. SNX does well because people are nervous about hyperliquid, and they're like, "Oh, this thing's ridiculously undervalued, and Kane's a good guy, and Dee Jinping turned into a a meme coin, and he really likes it, but it has a real product. It's filling a real niche, which is, hey, maybe there's worry about these other decentralized platforms. Let's try SNX." The vast majority of other things out there, like, what's a Cardano going to do now, right?
You saw the
like
reactions.
for the people that were levered long Cardano, are they going to get levered long Cardano again?
No. Yeah,
I don't
Yes,
know.
probably.
I mean, yeah, okay, fair enough.
They'll
Fair
take a
enough.
loan, or they'll show some reference or something to get a few bucks, and then put that back levered long. But
Okay, fair enough.
But they'll long it from down here after the dribble, not from.
Yeah.
maybe I'm being too, because this is what I want to happen. Like I want.
We say this
capital,
every time, and then 6 months later, and then it's like,
but it's 6 months later. That's the key.
yeah.
It's 6 months. You need
The
the
marginal bid for alts is dead now. Like that money, that was just,
But
it was coming
to
from
play
the meme coins and going to the perp dex farming, and then you had all these new people that were trying to learn how to perp dex trade and stuff, and they got carried out. So that money's gone. But then the institutional flows, which are driving Bitcoin mostly, all that stuff is fine. They're not on hyperliquid.
Yeah.
They're not perp trading on even Binance or anything. So
I mean,
it's ETFs. Like,
ETH was fine.
yeah, it's higher
yeah.
than.
If this had happened 6 months ago, ETH would
Oh
have
my
went
God.
down like 90%.
Oh
I mean,
my God.
ETH has a bid now, and that's really what I think.
Thank you, Chairman Lee.
Yeah.
Thank you, Chairman Lee. Thank you, BNR.
The contra, just to play devil's advocate, I probably lean more towards you guys' take on that, is just go through the positioning of these alts. Like leverage is obliterated, and in a lot of cases funding's still negative, so there's squeeze potential. And the other thing is, say we get a break in a couple weeks or month of corn to like a real, and we're moving again in a upward trending environment. I kind of think that all the people that just got wiped are doubling down and trying to make it all back. So I'm kind of, and are they going to go 4x on corn to do that? Probably not. They're going right back probably to the same games.
Yeah.
They shouldn't.
I'm not recommending.
That's true. But our job is not to tell people what they should shouldn't do. Our job is to try to predict what they might do.
Yeah.
So it's fair. It's a fair
Totally.
point.
And so I guess the big question now, just to play the tail risk situation of this whole thing, is, obviously everybody's thinking about 2022, where it took a few weeks for the dead bodies to start to float up to the surface. It took a few weeks to understand how that cascaded into 3AC. So, like, okay, maybe, whoever got carried out is still trying to, go get some loans quietly right now to stay solvent. So I could also see the argument that we haven't seen any. You got to wonder: do we see more for selling? Do we see these dead bodies start to flow up in a couple of weeks, and that could hamper the rebound? I don't know what you guys think about that.
It's definitely possible. I would say that it doesn't. I don't think it's going to be anything like a 3AC or a FTX situation, because in the 3AC situation, you had this one player that accumulated a massive, massive loan portfolio and just completely blew up. And no fund today is capable of doing that. No fund today can get the same size in the market relative to where the market is on leverage and then blow up in the same way. There might market makers take loans all the time.
Mhm.
It's very possible that there were market makers that blew up, and they do have debt. But it goes back to the who's net long, like who's massively net long that has debt to repay, that's going to need to sell outright assets to repay that debt. There are not that many people. Even the people that blew up probably weren't massively levered long outright.
Even the DATs aren't levered in that sort of way.
No, the
Yeah, well, the DATs are not. The DATs
it's all
can't.
equity funded.
Yeah.
They're fine.
The DATs are fine for now.
I mean, the prices might.
Because none of them got liquidated, as far as I know.
I mean, that would be crazy.
I mean, it'd be interesting to see what the market opens on those DATs. And actually, in half an hour, so I'm going to be jumping on the stream here to a DAT State of the Union panel, which will be that's great timing. I'm excited to dig into that one. So we'll get some takes on how they think about the State of the Union. But as it stands now, I don't see why they would be a forced seller.
No, they're equity, and those management teams will hold on for dear life for their, they got an incentive to not let go of those. I think, that was the big lesson in 2022. I don't think we're at that scale of a potentially this could have been a capital destruction event equivalent to some of the 2022 events. But the big learning there was don't jump to the gun, because you have to wait for the body, at least a body, to float to the surface before you have a green light. Like I kind of lean towards the next 2 weeks. You can kind of wait for confirmation or just be patient, because I do still see a period of, from a flows perspective, earnings perspective, corporate blackout perspective, just I don't see a mad rush to get back in. So, but I wouldn't expect anything huge.
There's an argument to be made, though, that if things come back fine, you're not going to be able to get back in because so many people just de-risked.
Yeah.
And I tend to be an optimist when it comes to these markets and err to the side of getting a little bit early.
Yeah.
Rather than getting in late, because it also psychologically makes it easier to hold that position and actually get in that position. And so, because of what we just saw with this huge amount of de-risking, both in TradFi and in crypto, if the market continues to tick up and doesn't revert over the next day or two, I think you start to get some real FOMO back into the market and people start piling back in, because it's one of the hardest things psychologically
especially if you got liquidated,
to lose money, have the market go down, and then have it bounce right back. You get this. You one of two things happen, because I've seen this happen to fund managers, to friends. You either turn into a perma bear.
It's possible.
And you go, this market's a scam. Everything sucks. I'm going to short. And in that case, they're short. They're like upside liquidation fuel. Or you are like, I can't miss out on the next run. I have to get in right now.
Yeah.
And I think that's why you I'm almost the opposite. I'm like, I kind of want to move fast into the market now. And if things don't move up quickly, then I'm cutting. I'm almost that's the way that I'm thinking.
It's your entry too, because if you're buying up here after the big
rebound,
mean reversion bounce, but I agree. Like Bitcoin carved a beautiful, ETH carved a beautiful candle. Like you have to see stocks, even if stocks chop, we could be in a scenario where stocks are down a couple percent from highs at the end of the month, and corn's kind of back to highs, and
100%.
Nothing happens.
And I think you gotta.
We're chatting live right now.
Yeah, well,
Jeff Park,
you're next.
He's going to be on here at 2:00. Jeff, say hi to the camera.
Jeez, our next guest.
Our next guest coming up.
Can't take this guy anywhere.
Jeff's a great guy.
Jeff's the best.
We love Jeff. We love Jeff.
That's the magic about doing these things right in the moment. That was not planned at all.
No, that was great. Where was I? I lost my train of thought. Oh, I was gonna say, we haven't talked about gold.
Yeah.
And I think that the reason it came to my mind is because of what you said. Bitcoin can go back to all-time highs with equities down because gold is still ripping.
Yeah.
And it's like the thesis is playing out before our eyes. Where's capital going to go? Like we're flush with it right now. Central banks keep buying gold as well, and the higher gold goes, the better relative value Bitcoin looks. And I remember when gold was, I think it was when it was 2000, it was what, like 12 trillion or something like that. It was like 12. When it was $2,000, it was like 12 trillion.
Yeah.
And Bitcoin's almost there. It's within shooting distance. Like I would have said now, oh man, like maybe Bitcoin doesn't have great risk reward because if we're comping it to gold, like it's actually getting pretty close to that 12. Now gold's 25 trillion, and so now we have a much larger ceiling, and that's what makes me pretty bullish on the market in general. Is that we have massive tailwinds still.
For sure. It's very rare. I talked about this in my LP update call last week. It's very rare that gold is doing what it's doing while risk assets are at all-time highs and moving higher.
Yeah.
It's a very rare thing. And that, I don't think, we talk about debasement, we talk about fiat going to zero, but I don't think we quite even really understand how big of a problem it is, because normally gold is a safe haven asset that is a beacon in a storm, and people are rotating capital from a stock bond portfolio into it. And it's like we're seeing every boat. And that's, to me, a sign of the actual liquidity and debasement issue, where all these assets are rising on a nominal price basis. And we are underestimating what that means for nominal prices in general. And to me, that's why Bitcoin is like this on 3 years, because nominally it is inflating, aka the denominator is deflating, and that is a strong enough tailwind for 15-20% a year. And then you get the big sailor front ran. But we effectively in corn haven't gone anywhere since December 24. 10 months. Think of that. 10 months. Price hasn't gone anywhere. What's the move going to be when we get out of here? We're talking a November 24 or a October 23 move, in my opinion, when we come out of this.
The hard part is just
10 months of consolidation.
The hard part is how messy that process is because of all the leverage we just talked about. Like gold, it's just like you look at CME positioning in gold, it's super muted. So it's just like constant TWAP from central banks in China. And then Bitcoin, it's like, last week we saw that breakout to all-time highs, and then it's like psych, everybody goes max long on leverage.
Exactly.
Breakout, open interest explodes, and then you get one negative tweet, and then the whole thing just implodes. So it's just like,
and everyone's like, is it over? This was the 4-year cycle top? And you're like, oh my God.
Dude, I think that is key, is that now you're going to get all the people that think, all right, 4-year cycle is over. We had that moment. It aligns the timing. And then my read is that I think 2026, like you look at that macro backdrop, it hasn't changed an ounce. For me, you got big, beautiful bill stimulus finally kicking in for good there. You got Jerome Powell getting replaced. Regardless if they can control the Fed, you're still going to have a super dovish Fed chair, regardless.
Yeah.
So that's all going to happen. So I think you're going to get the people that are cycling out for the 4-year cycle. And then 2026 is going to keep coming in. That institutional bid, like they don't really care about the halving cycle that much, right? Like they're not.
If anything, they're going to do the math and realize, whoa, that's bullish.
Yeah, exactly. So they're going to keep bidding. And then 2026, I think it's going to catch a lot of people off guard.
Yeah, I mean, one thing about the 4-year cycle, and I've talked about this on a previous podcast on 1000X, is that it looks completely over because the 4-year cycle was driven by attention and adoption. That's what it was driven by at the end of the day. It was people would talk about Bitcoin because of the halving. People would get excited about it. Bitcoin was hugely underowned by the entire world. And so you'd go through these boom bust cycles of massive adoption, a couple people fall off. Massive adoption, a couple people fall off, all centered around the attention cycle of the halving. Since the FTX bottom, if you're at home and you're watching this, or if you're watching it later, go on TradingView, put on a weekly chart of Bitcoin, and just tell me, and put it on log, does the last 2 years, 3 years look anything like any other year of Bitcoin?
No.
There's no parabola. There is no 100% in a week. It's actually a pretty gradual rise higher, because what's happening now is I think we're past the attention phase. Now we're in the slow adoption phase. Everyone in the world knows what Bitcoin
And you look at Bitcoin vol just like this at the same time.
Bitcoin vols now, it's,
Yeah.
you can see like high 30s, 40s on options.
Yeah.
It's like we're in the slow adoption phase right now and allocation phase. Everyone knows it's not the attention phase anymore. So my view is that it can follow what gold did. I mean, you see gold went sideways for a while around that 3,000 or 3,300 level, went sideways for a while, and then just straight line up to 4,000. I think if Bitcoin manages to stay above 100,000 for the next month, you buy it and you can see 200,000 in the next 6.
I
mean, it basically, unless it completely collapses, this thing is about to rip because of that dynamic, right?
Yeah.
Because there are people, a lot of people, OGs, that sold because
The
of the 4-year
distribution of
cycle.
the last 10 months is
Oh, yeah.
wild. The
Yeah.
A lot of
distribution
people.
Yeah,
the
you
last
got
is
ancient whales getting
right.
out. Yeah.
huge.
And guess what?
Distribution
I
is
guarantee you they're back in if it starts ripping.
Have to. Like,
They're addicted. I know that because because I anyway, it doesn't matter why I know that, but I might be addicted.
Yeah. It's not just Bitcoin, by the way. It's Ethereum. When I talked to, if you look at the distribution, I talked about it last week.
Yeah.
It's a phenomenal amount of long-term the selling in both. It's we're primed. You just need to get the geopol settled down. But either way, I mean, on a relative value, when you plot it versus stocks versus gold versus, I think people are seeing this, and what a better move before Bitcoin always does something. This reminded me of August 17, 2023. I don't know if you guys remember that. I remember it because I was on a flight to vacation in the summer and get off the plane and everything got nuked 15%. Nuked.
Yeah.
Like everyone was like, what the heck just happened? It was August 2023, and that was a massive clearing event before one of the biggest runs in Bitcoin's history. It doubled in the next 4 months after that. I kind of think this was August 17, 2023, where everyone's kind of looking around like, what was that about?
Yeah.
No one really knows. And then all of a sudden you're like, wait a second, this is a great entry for every single person who wanted to get into the asset class that couldn't.
Yeah.
But part of it is a rotation out of alts. Like when alts get wiped, people consolidate into majors and they consolidate into Bitcoin. I mean, how much did they say was liquidated? 40 billion?
Something. Yeah, 20 to.
Yeah.
If you had 40 billion that shifted into Bitcoin, that's going to send the price higher. If you got half of that, if you got let's say a fourth of that capital comes into Bitcoin, because they're like, okay, I'm out, because the total losses are nowhere close to that. Total losses estimated 3 to 5.
Yeah.
Right. So there's still a lot of capital out there that can get into Bitcoin. If it says, if these people, if you, the listener, have the courage to eschue
to buy
alts,
my bags,
exactly, and get long BTC, and I'll give you some numbers to back it up. I tweeted this, but for those that didn't see, if you're 10x long a 40 vol asset Bitcoin, you're looking at about a 2% move a day. On average, the one standard deviation move is 2%. If you're long 120 vol asset, which is like a Solana or other altcoin, you're looking at a 7.5% move a day, standard deviation. That means if you're 10x long, there is approximately a 20% chance that you will get liquidated on a alt position, and about a 0.001% chance you get liquidated on a Bitcoin position. Huge difference. So like, I guess what I'm trying to explain to you is that the risk profile actually, to me, always makes a lot more sense to go bigger on the large caps than to go, to basically take out leverage on the large caps than to take out leverage, even much less leverage, like a 3x, 4x long on an alt versus a 10x long on a Bitcoin, in my mind, are comparable things.
You look at the upside of the last few years, even only adds more credence to that.
Yeah.
Because you're not playing for the same alt upside you were 3 years ago. You get
All right, we got 2 minutes left before we wrap up and go to the next thing. But just want to hear you guys super quick. how are you navigating the next month or so? It sounds like we're all kind of in agreement. It's like you still have this pocket until the end of the month because of that possibility for Trump and Xi Jinping to keep going tit for tat higher, and then that off ramp. So yeah, how do you guys think about that for the next month or so?
I mean, my answer is I'm in the market right now.
Yeah.
I'm a buyer now, and if nothing happens in the next 3 days, then I'm out. But I think now is the time to move fast, personally.
Yeah, I'm a believer that this move out of here, if and when we get it, will be dramatic and sustained. So I'm maybe in a little less of a rush. I'm sort of in like scale in mode over and if you get confirmation of a move higher, slam, or if you get a pullback into value, slam, and kind of strategic that way. I think if the biggest mistake you can make is taking this one-off event as like, shading or dooming the prior view, and kind of leaving the market, because it's
Yeah,
these things always happen, like darkest before dawn type of thing.
100%.
Yeah.
All right, that's all we got for this first segment. We are going to be cutting to. We got some afternoon panels going live there, so we're going to cut to that for now. I'll be going on live at 2:10 London time, whatever that is for your guys' time zones, for the DAT panel. So we'll be doing that, and then right after that, we'll be jumping back in here with Jeff Park, who made a nice little cameo there. That was awesome. So yeah, look forward for that. So yeah, next time I hear from you all, we will be live on that DAT panel. So see you soon. Avi, thanks for joining, man.
Thank you so much.
Yeah,
That was really fun.
Yeah,
That was really fun, guys.
Yeah,
That was awesome.
all right.
A very, very good start. Yeah. So the topic today is around the blurring of the lines between public and private markets, and that is one of the reasons why I got into blockchain in the first place, because the access to public capital anywhere around the world, the big promise. I got into blockchain around 2014, 2015. I'm kind of interested to hear from you guys how far you think we've come since then, and are we on the right trajectory? Maybe you can start.
Yeah. I mean, crypto's changed so much since I first got into the space. So I came into crypto full-time in 2017. And at that time, crypto was still, I mean, one, it was very subversive. We're now here at DAS. There's way more suits than there are kind of crypto cypherpunk people. And there's no conferences that look like that. I think it's also a testament to how much crypto has, in a way, it's gotten subsumed by what it originally trying to disrupt, and it's now disrupting from the inside rather than the outside. So, if you look at the Bitcoin Genesis block says that basically Bitcoin is an insurrection against the banks. And now you have banks launching their own stablecoins, and you have figuring out how they can accommodate what's going on in the industry. So total reversal from what I imagined it was like when I first came into the industry in 2017.
But I mean, I get it feels different. It does really feel different from 2015, 2016, 2017. But I still don't feel like we're making progress towards all markets being tokenized, everyone being able to buy tokenized assets.
You don't think we're making progress?
I mean, we're making progress, but I think it's been 11 years. And I mean, when was the last time you bought a tokenized anything that wasn't a crypto utility token?
Well, I think that's a good question for some of these other guys.
I think in this industry, it's important to understand, like, are we making a marginal improvement in the current paradigm? And I think it's not to say we're going to make financial systems perfect. There are clear challenges with crypto market structure or pricing. Like anyone paying attention to the last 2 days understands that. But it's important to just understand, are we making the system better, more transparent? And I think if you go back to 2008, where you launched Bitcoin, and it's responsive to global financial crisis, why did the global financial crisis happen? Because you didn't have any sense of transparency in the system. It's really fragile. You don't know if your counterparty is solvent. And if you look at how DeFi behave, I think you're in a paradigm where, look, DeFi is not perfect, but you do have a system that is incredibly resilient and it's transparent. It's not going to fix everything, but I think just having transparency in markets is a better state than the current paradigm. So I think we made incredible progress. And days like the last couple of days inform us areas that we still need to fix. So it's not perfect. I don't think we should trade it as perfect.
What's the biggest barrier that we have between where we are today and where we're between everything trading on tokens all the time, freely, transparently? Is it a technology issue or is it a regulatory issue? I'll come back to that.
If I look at
if we're going to hit 2 trillion perhaps of stable coins in issuance in the next couple of years, which is roughly where JP Morgan think it's going to be, maybe we'll come up with another stat. We seem to be making some good progress. And I think as Santiago says, it's for very good reason in terms of the transparency. You know, whether it's the great financial crisis in 2008, or I can actually, frankly, the first IPO I was involved in was now 25 years ago, and the company that I'd started. And it's not just transparency, it's an inside club. It was then, and it's just as much, you know, an inside club now. I think we can move away from those things if we have proper tokenization of all these different assets. However, there are a number of reasons. There's we need to make sure the market infrastructure is there so you can cope with, you know, the long tail events, for example, the crises. You need to make sure there's just the right amount of regulation. And we have to be, I think, honest with ourselves that for startups, and most of what we do at Fabric is to sort of, you know, get involved with people right at the beginning of their journey. For startups coping with being, solving technology problems and risk, hiring co-founders, and sort of say issuing a token and being a publicly listed entity from the get-go is pretty darn complex. So I think, you know, we still need to work out, you know, before we allow that to happen for pretty much any asset literally under the sun, we need to continue to work out the startup science about how we make that work effectively before, you know, so folks either don't get too greedy or just go off the rails.
So I want to talk about this weekend just for a second. How did we do this weekend? I mean, let's actually talk about.
We're live.
We're live.
Haseeb has written.
But I mean, I think any market, the stress test is the only test that actually counts, because under normal conditions, everything works well. But we had a stress test this Friday. It shouldn't have been a stress test, because if you think about the underlying cause of what happened, it shouldn't have cascaded like that. So what happened? Where did we go wrong?
Well,
where did we fail?
A few things. So one, this is the largest liquidation in crypto history.
But
why?
What's that?
It's like 10x bigger than.
Yeah, it's 10. Well, I think some of the numbers are probably not trustworthy, but it's definitely the biggest.
Yeah.
In large part, just because the market has gotten so much bigger. And so in relative terms, obviously, when FTX collapsed, when the COVID collapsed, those numbers were larger, but the market was so much smaller back then compared to what it is today. So that's one thing. Second thing was that the number of traders in this market has also accelerated by quite a lot. And the APIs that people have set up to be able to accommodate all of the traders that are interacting with them, like what you saw was that it was not actually the blockchains that went down. The blockchains were fine. Solana was fine. Ethereum was fine. You know, Hyperliquid was fine. But the APIs that people were using to interact with these things were falling over left and right. So this kind of load test, there's no practice run you can do for it, right? It's like when Trump dropped the meme coin and all the Solana wallets went down. There's no way you can simulate that kind of load, because it's just another order of magnitude. And they had basically a couple hours of borderline downtime where people could not get money in and out of Binance. Withdrawals, deposits were having issues. APIs were failing. But actually, most of the other exchanges did okay. Auto deleveraging happened. There was very little bad debt across the industry. DeFi performed swimmingly. So some things went well, some things went poorly, which is always how it is when you see big events like this. But overall, I think what it showed us. So I want to jump on this point Santi made, which is, you know, when Parify is trading in a normal market and you're running low on collateral, you don't get just, you know, automatically liquidated when you hit a certain price point. Instead, you get a phone call, and the phone call is a very nice phone call. It's like, hey, Santi, you know, how you doing? Santi, you know, how you doing? You know, your maybe it's not so nice, but it's like, hey, you know, your collateral's running low. We really want to top you up. We don't want to liquidate you, right? And in DeFi, that's not how it works. In DeFi, or even on exchanges, right? Like the way that it works is that the moment you are below this level, boom, you get liquidated. No conversation, no phone calls. It's cold, mechanical, programmatic. And we often tout this as one of the virtues of DeFi. But of course, you know, if you're Parify, you maybe don't like the fact that you don't get a phone call. And why is that phone call happening? The phone call is not happening because, you know, traditional businesses are stupid and they don't understand that, like, you know, it's riskier to call somebody than not to. The reason why they're doing that is because this traditional business is basically, they know that you're a good customer. Mm-hmm. And they want to keep you as a customer. And the grace window they're giving you is basically credit extension. Because they're like, look, Parify will top up. I know Parify, they're good guys. And that credit extension doesn't happen in DeFi. Right now, if you're a long-term borrower,
we don't have privacy.
Maybe you want to add something.
Yeah, I actually think, I mean, so my big picture answer to your first question of how we're doing is sort of that everything is happening exactly as it should to get to our destination. I even think we sort of owe Gary Gensler a debt for holding down the tokenization and stablecoin market while our infrastructure improved. And I think that to your point, by which I mean that if we had obviously, I have a dartboard that I throw at Gary Gensler's face every day. He's not my friend. But broadly speaking, if we had this kind of sort of traditional engagement in crypto 4 years ago, when transaction fees were spiking on NFT volume, the whole system would have collapsed. Wall Street would have written it off for a decade, and we would have been delayed. I think we're going to get there faster. And I feel like that about this weekend as well. Everything you said is true, and I think we'll get better next time. And a few people sort of effectively had those phone calls, right? There's a lot of talk about Athena being hard priced. That's almost the equivalent of the Parify phone call. And I think next time there'll be more of those bilateral arrangements. So I sort of think we're training at the right pace to get to the ultimate destination, and it's almost happening almost perfectly. So I think we're making pretty good progress.
Well, you seem satisfied even after the carnage of this weekend.
Can we go back to
maybe not happy? I just mean that it was a proper learning experience, and I expect that the market will be better. It didn't end anything. No one collapsed. And I think we'll improve
we don't know
that we know of.
Yeah, we don't know.
But my point is, as an industry, I think we've been waiting for regulation. We're a very different environment and regime now. But I think as an industry, it will serve us well to put together some guidelines of how we want to operate. I'll give you an example. There's a tweet of Brian Armstrong a couple hours before all this went down where Coinbase now allows 50x leverage.
It's about time.
But what I'm trying to say is that the right thing to do? And look, I get that we are touting ideology in this industry of decentralization and openness, but there comes a point where you ought to wonder if that is the best product
one specifically when it actually gets tested. The perps dexes, the decentralized perps dexes, handled beautifully. Hyperliquid handled beautifully, probably one of the best. It passed the flying colors. Then we look at the centralized part of the industry, and they fell terribly. They were manipulated. People got liquidated when they shouldn't have got liquidated. Tokens went to absolute zero. It didn't happen on the decentralized exchanges. So I think, for me, the silver lining is that where we're heading to, which is a decentralized world, actually did very, very, very well. The minute we brought back centralization, I think, I mean, I'm going to say the quiet part out loud. I think that this was a very highly coordinated attack. I don't think that this weekend was coincidental. I think that this weekend was very, very, very highly coordinated. Let me give you
whom?
Well,
By the decentralized
I'm not
exchanges?
gonna say who I think, because it's too dangerous. No, I'm not gonna
The
say
debate
who.
is going in a very different direction.
But hold on. Let's just talk about some facts. When did this liquidation happen? After the US markets were closed, when Europe was asleep, and when Asia wasn't online yet. Okay, period of zero liquidity. Get attacked. I don't know if you saw, but there were a CoinGlass who was supposed to give the data as to what was actually happening in the market, got hacked at exactly the same time, and the oracles got manipulated to give you prices close to zero. You want to tell me that that's not a coordinate? And by Monday morning, everything's fine. Like, if you switched off your phone on Thursday, you arrived back on Monday, you didn't even know what happened. Now, by the way, it only happened on the centralized exchanges. On the decentralized exchanges, nothing happened.
So maybe if you work backwards from this idea that, look, crypto is a system that it will constantly be attacked, because as it's a very adversarial environment. Go talk to any founder in DeFi and they'll tell you, like, you build Lindy, and there are protocols that have built a lot of Lindy. There seem to be common recurring themes as to why things fail. Oracles probably being the number one, and then market structure just happens in these. Like, go talk to a high yield bond trader and he'll tell you the same thing, that the high yield market sometimes really dries up. So what should we be like, do we draw a line of, like, I know it's permissionless and I know anyone can do whatever, but are there, as an industry, should we focus on, if we just assume that this is not going to be fixed, should we work backwards from there and say, hey, maybe we shouldn't be tokenizing? To your point, like, maybe it is worth taking a little bit of a buffer and saying, let's maybe hold off on opening Pandora's box, or maybe Pandora's box been open and you can't peel it back.
I think it's the other way around. I think that it's the centralized part of the industry that is controlled by centralized figures is destroying the part that's actually is the most vulnerable, and it's destroying the part that's actually working. If you look at the collapses that have cost us money in this industry, you look at FTX. Okay, that was the centralized party failed. You look at the Luna, what subsequently came out as the Luna manipulation. It wasn't the protocol that failed; it was a centralized party that failed. And so, time and time and time again, I think that what we're seeing is, the quicker we move to a decentralized, non-human, non-manipulatable, non-corrupt situation, the better.
Well, I would say some hyperliquid traders might have an objection to building a Frankenstein of, like, just an automated liquidation. Are they reading the fine print of how that mechanism is going to work? Like, I mean, Haseeb, you guys are very involved in that protocol. I don't know if you have an opinion, but, like, you know.
Yeah, I mean, so in a world where hyperliquid exists, it's very difficult to argue that, like, oh, well, the centralized exchanges, they should protect you from taking on high leverage, because there will always be some protocol available to you somewhere where you can go get 100x levered, right? Coinbase is offering 50 is like basically kind of the median, I think, for most exchanges that offer high leverage.
There's some
hyperliquid offers more than that.
There's some exchanges that offer 1,000x leverage, and to be honest,
1,000x leverage is a joke.
So to be honest, I actually took a trade. I took a trade on a.
You took a 1,000x leverage trade
just for fun, just to see how it works. And you cannot believe the speed at which this trade moves. It is.
How'd it go?
It is absurd. I lost my money. I lost my money. I don't think you understand. I don't think you understand how.
Yeah, that's like 4x
leverage. Right? No, I know. That's why I think it's mostly self-correcting.
Yeah, that's the thing. There's a reason why people don't offer 1,000x leverage, is because your customers will immediately churn, because they will lose all their money. They're like, look, we're investors into Bybit, we're investors into BitGet. We know a lot of these exchanges. We've known them for a long time. It is just not true that people come on these things and gamble at 50x leverage and lose all their money. You would immediately lose all of your clients. That's not how these exchanges work. Most people trade at relatively low amounts of leverage, but the headline number gets somebody in the door, because it's like, oh, this exchange only has 10x leverage or 5x leverage or whatever, and maybe the moment that I do have super high conviction on something and I want to take an insane punt, I might. The other thing to remember is that most people are not trading alts, right? Most of the open interest in
Yeah.
crypto is on the majors. And Bitcoin and ETH did not move anywhere near the ferocity that you saw in alts, right? The alts unwind was very much for a different reason than what you were seeing happening in the majors, right? Bitcoin traced from, what was it, 120 something
106.
to like
Well,
110?
Well, let me just maybe frame the question. Matt, I'm going to throw this question to you. How much damage do you think that that last Friday did to the cycle? You had, they say 20 billion in liquidations. The on-chain data shows that it's probably way more. They say 1.7 million people got liquidated. I think it's way more. How much damage did that do to this cycle? I know in the big scheme of things, we'll probably forget that this weekend ever happened.
Yeah.
But in
So-
this
so-
cycle, how much damage was done?
I mean, so my starting point, Bitwise serves primarily professional investors, family offices, financial advisors, institutions. And my view is this cycle, which I think is going to extend for many years, is driven by those investors coming into crypto. And everything else doesn't really matter for the term of the cycle. So given that framing, the answer is not at all. Because those people closed their computers when Bitcoin was at 117 and opened their computers when it was 115. And the weekend literally never happened. Like my ETF didn't experience the weekend. And so
Bitcoin also didn't experience the weekend if you look at it.
well, there's that. That's a whole nother thing. But I don't think it's. I think this
Hard
is. I think this is unique to this corner of the market, and we've seen these sorts of giant liquidations in the past, and actually they're non-determinative of future returns. If you look at the last 6 largest liquidation periods, 3 of them ended up a year later, 3 of them ended up down. So that's slightly negative skewed versus the average, but they're not like deterministic. And because this cycle didn't affect who I think is, or this weekend didn't affect who's driving this cycle, which is professional capital that are at 0 going to 3%. I think that's what's driving the cycle. I don't think it will end up mattering.
So totally agree with this. The other thing to remember is that we're talking about perpetuals, right? We're talking about futures. And these futures are zero sum. It's very easy to forget that. But futures are zero sum, which means that for every dollar gained, somebody lost, right? But like it's 1-to-1. There is no creation or like it's a pot of money and people are betting on who gets the pot of money. So the liquidation was good because it has reduced the leverage in the system. And clearly there was a lot of leverage. I mean, we saw all the craziness going on with the BNB coin rotation and all the leverage trades people were making, and all that stuff has gotten unwound. That's healthy.
40% of the entire crypto leverage ex CME, because obviously CME was closed. 40% of the entire leverage of the market was completely wiped out.
Yeah.
Between
And this
That's
happens
great.
routinely. This happens routinely in bull runs. Is that there's a reset. A lot of traders who are taking leverage one way or another, they get wiped, and we start over now with less leverage, more spot driven than futures driven.
Yeah.
And that's healthy.
Yeah.
I agree with you, but the reason why I agree with you is because I think this cycle is institutionalized. And as you said, the institutions, they were playing golf on the weekend.
Totally.
I think I had to remind a lot of people today. We have a call every morning, and I had to remind them, like, guys, not everyone follows crypto every minute by every minute by every minute. Some people will check the price on Thursday and check the price again on Monday.
The people driving the market can't pronounce Solana.
That's absolutely correct.
That's a meme right there. But I do think it matters on the margin. I get it. The ETF flows and have been instrumental in the cycle, and they're the front row seat, and they're driving. There is an element of RWAs which is emerging, and I do wonder around this tokenization aspect of if you're bringing more tokenization of different instruments, and you look at the market structure, stuff like Athena, and how you could have an opinion on, is it okay to hard code? Is it? I do think it poses the question of are we ready to bring this kind of more and more RWAs on chain? What does that look like? Because again, you're moving from a paradigm of Monday to Friday, 9 to 5, orderly markets. You close your computer, and
you can phone the Nasdaq,
and you can phone the Nasdaq to like now real time markets, global liquidity, composable, in interoperable in real time. Like I don't think we're there yet.
Yeah. So building on that point, exactly. The topic of debate here was kind of meant to be something to do with public-private markets, and
but you always
not that matters, by the way. Not that matters. And actually, I was thinking before, it's actually the wrong question in a sense. I think we all agree the destination is like tokenization of everything, and radical markets are just different descriptions. And so, in your point, I think I agree with, which is like, are we ready? We should think carefully about that, and putting aside any conspiracy theories. I'm not saying that there isn't mileage in that, but let's put that aside for one moment. I think we can probably all agree, although I'm surprised by your opinion on this, that leaving it to the market to decide, for centralized exchanges to decide what they want to offer in their kind of shops is probably the best way to go. In fact, the only kind of workable way to go. And then things will self-correct. But what I wanted to point out is something that you said, Hasib, and I think Santi, you commented on. You said, well, actually, you suggested we could do work on it. How do we make sure that people think about the entanglement we have between these, in this real-time world, between decentralized and centralized world? Think about the scenarios that we're going to encounter in the future, simulate those. And also, on your point, I was actually surprised. We can, of course, we can programmatically come up with a lot of scenarios and test rigs for those APIs, and we should. I mean, I've done it myself back in the day, and I'm sure we could come up with the most probable ones if that was the right way to do it, and some folks do it. So I think, for me, that sounds like an opportunity for building new companies and products to solve these problems, which is
it's very simple. Stablecoins, let's just work from fundamental premise, which is there is a lot of financial literacy, and you will never change consumer behavior. Stablecoins, programmatic yield. You look at JP Morgan, the amount of money that sits on checking accounts that is not sweeping into a money market account is staggering. People are not sophisticated with their money. That will never change. As much as we want to drive technology, it will never change. So a stablecoin that comes in and programmatically rotates and does that for you within a certain parameter that is expressed with code is beautiful, because it eats into the business of banks and it translates consumer preference to people that should be earning a very low risk treasuries, 4 or 5%. That's great for consumer. That's great for the economy. Stablecoins as programmable money is amazing. That we should lean on. And I think that's great. But assuming that people have, and then the other extreme of that is allowing your grandmother to go 50 times levered on Dogecoin. But somehow I think
there's a market for both.
But I do think that's where we need to draw the line around. We are in an excellent time in the industry to craft sensible regulation, and I think this is a moment to get rid of archaic rules and regulations and do sensible regulation, because there is more financial products that are available for people.
So what do you think we should do with the grandmother?
Yeah, so with the grandmother, it's very simple. You have on one end accredited investor rules that make absolutely no sense, that were drafted, predates the internet, and they're like, if you make $200,000 a year, somehow you're equipped to make investment decisions. There's, of course, the knowledgeable investor rule, which allows people to prove that they're knowledgeable or an insider in a company, and I think we should lean more on that, right? If you're an exchange, we'll gamify. Binance does this to some extent, or you have to answer a questionnaire. Or do you understand kind of how this works? You understand how perp works?
Are you sure you understand how next leverage works?
And I do think that we should, we're in a world where we can create UI, UX that qualifies people such that they really understand what they're doing and prove that you have the financial literacy to go 50x levered. I don't think exchanges are doing enough of that.
So I will take the other side of that, is that actually, so I mostly agree with you about people who are trading high leverage. They're just gambling. I think we were just talking about this backstage, is that apparently in Monaco, there's famous casinos in Monaco, but if you're a Monaco citizen, you cannot go into the casino. Oh. Only foreigners are allowed to go trade or go gamble in the Monaco casinos. Same thing in Singapore, actually, is that Singaporeans are not allowed to gamble in Singapore. Only tourists are allowed to gamble in Singapore. And so I'm sort of partial to you take one or the other. Right? If you are, look, if my grandmother would unfortunately not trade, or fortunately for her, not trade Dogecoin.
You never know.
But if you are sufficiently motivated, you will figure out a way to pass the test to allow you to trade Dogecoin. And when you do, I don't know that that's much evidence that you should be going 50x long Dogecoin, is that you understand how liquidations work, right? Yeah. But I think at the same time, it's look, either you say this stuff is socially harmful and we should make it impossible for people to do it, which I think DeFi makes it very difficult to actually enforce that. But put that aside, I think either you should say, look, people shouldn't be allowed to do this, period. Or you say, look, people, these tests are.
Let's go. It's very simple as opt in, opt out. Go look at Richard Thaler, behavioral economics of how you design a product. To your point, if the default leverage on an exchange is 10x, we have a problem. Because people got liquidated over the weekend on 1.5 to 2 times leverage because the Oracle, this is a very volatile asset class. Let's work backwards from, but shit's going to go down 80% in 20 minutes. even if you have 2 times cross collateralized, cross market, you're going to get blown out. And so that's where I kind of draw a line. Like the default shouldn't be 10x. Maybe it should be 1.5 or 2.
But I think there's twice in the last 6 months that you would have been blown out on 3x leverage. In February when Trump announced tariffs.
Let's think probabilistically.
Yeah.
I
But Ren, what is this exchange that's 10x by default?
I don't want to mention it because you're an investor.
Oh, okay.
Okay.
Yeah, I don't know. All right.
I mean, most exchanges, if you go into the leverage, the default leverage is 10x.
Nice round number.
Right.
It's a great, yeah.
Yeah.
And I mean, remember, we have a big community of traders and we can see what they're doing. And
Yeah.
the leverage, the average leverage that they start off is 10x. No one starts off with 3x.
But I agree with Hasid that the market will determine how that plays out. You know, that as the market broadens, as a kind of the consumer base broadens, and unfortunately, as people suffer from more Trump tweets, that, you know, something will happen and people will no longer choose the platform, you know.
I mean, look, you see this with Robinhood, right? On Robinhood, you cannot, like, they don't have the, trade with leverage, but they allow options. And with options, you can construct any leverage profile you want by just constructing your option in such a way that it's basically equivalent to taking on 20x leverage, 30x leverage. So the reality is that people, if you don't give them leverage, they'll buy some crazy meme coin that is effectively leverage.
Yeah, I think I mostly agree with that. I think it's mostly self-correcting. Like, people don't buy meme coins. That's self-corrected. Many people are skeptical of ICOs. That's self-corrected. I think the industry would be better off if it didn't exist. So I actually agree on that point.
But I'm better off if what didn't exist.
Well, if we didn't have 100 and 1,000x leverage, but I think there are downstream consequences of making that impossible that are probably larger. And I would add, I think we're over-focused on this element of the market. If you put this in a traditional context, and these were stocks, and, you know, X% of levered traders got blown out over the weekend, it wouldn't change people's view on NVIDIA, right? It wouldn't change people's view on the stock market. I think that's probably true here too.
I mean, it's kind of crazy that we're evaluating the merits of this technology because the price goes up or down. Like, people don't make a decision to use AWS or Azure because the price of Microsoft or Amazon goes up or down. Like, hopefully we get to that state soon.
I think
like Solana,
the whole industry is around creating value. And when you create value that didn't exist, people are going to trade it.
Yeah.
And so I think that is how you got to evaluate the industry, is how efficiently value can trade, because all we're doing is creating value.
Also because most of the value we have delivered to date has been associated with the kind of world casino, not the world computer. And to your point, so hopefully we go beyond stablecoins to RWA.
So Solana gets 70% or 80% of its revenue as a chain from speculation and meme coins. We were going to get to a state where we will onboard users. We will have activity that is not correlated with the self-referential reflexivity of this industry, which is it's all tied to a casino. Again, we're selling ourselves short as an industry. We will fix this one way or another, whether it takes 20 years, 5 years.
So that's my next question: is who's going to fix this? Is it going to be Binance, Bybit, BitGet, all the ones that you mentioned you're invested in, or is it going to be the banks? Is it going to be Robinhood? Is it going to be JP Morgan? Is it going to be who's going to fix this problem?
Why are you looking at me?
Because you're an investor.
All right. Look, I think the answer, I'm very partial to the answer, is that it mostly fixes itself. Is that in the early days of any technology, of any big installation of a society shifting movement, there's a lot of speculation, always, whether it's railroads, canals, the internet, telecoms, all of them had gigantic bubbles. All of them had a lot of speculation. What drives speculation? The answer is excitement. Excitement is what drives speculation. People don't speculate over, GE and, washing machine companies because they don't care. So now that all being said, are there things you can do at the margin with respect to market structure to make markets more stable and reliable? Yes. And the way that we're figuring this stuff out is not because, there's some global regulator overseeing Binance and making sure they do the right thing. It's Binance doing the right thing, or they die and they get replaced by somebody else. So I think the reality is that this industry up till now, in spite of all the regulatory fury that's been pointed at it, it's mostly been self-regulation that's gotten us here, right? Binance doesn't work the way it does because someone told them to work that way. For Coinbase, maybe you could say, okay, well, obviously they're hewing much closer to regulations, but the vast majority of crypto today trades on Binance. It's 40% of the global market. Coinbase is less than 5% globally of what happens in crypto. And so that global market has gotten the way it is through basically learning by doing, through repeatedly going through these getting punched in the face moments like we had this weekend, and figuring out, okay, what can we do better to do this better next go around? And I think that's mostly going to continue.
I'm interested to know, just from the audience here, how many of you got punched in the face this weekend?
Well, if they did, they're not going to raise their hand.
No, I mean, I'm
We got at
really,
least one- we got at least one face
three.
I'm really keen. I'm really keen to know whether
This is not the leverage trading crowd.
Yeah,
I
yeah,
would
we're-
say.
No, what,
Yeah.
Not here at
what,
that.
what I want to know is how many of these people actually did get punched in the face just because they took 2x leverage. Because I think 2x leverage is a responsible leverage to take,
I think
right?
that's irresponsible.
That's when I
Guys,
realized
you're
Not
not
sure.
you're not
Yeah.
responsible.
I mean, 2x on Bitcoin or ETH is not irresponsible.
Well, you got to look
No,
at it in the framing of volatility. Yeah, it's a lot, but yeah.
It's still levered. Yeah.
Yeah, look,
Um,
most people don't trade with leverage. The notional of people trading with leverage makes it a very, very large number.
So you think it's just completely insignificant, like in the big.
It's not completely insignificant, but again, like there are as many people who made money as who lost. That's how perpetual swaps work.
Yeah, well,
Yeah.
look, I'll tell you what I think, which is there's a whole segment of this industry that people are waking up to Bitcoin with products like yours, and that's phenomenal. That's great. Getting off of zero is important. Bitcoin is an instrument that is a commodity. It's like very separate out bucket and the rest of the industry. I think our focus at Inversion is really this idea of injecting this technology in businesses and making them more efficient. And I think there are very specific operational improvements that you can make to a business if you introduce stablecoins. And I mean, it's huge. Working capital, settlement times, conversion cycles, like that is a very measurable impact that, heck, it's even more than AI. Like if you look at the drag, it changes the consumer relationship. You look at large, and the best part of this is large companies, public companies are now doing this like Nubank. They've really improved their unit economics, their onboarding, their customer acquisition costs has gone down because people in Brazil and Latin America want to get access to dollars and tokenized dollars. And that is just one example of, again, moving away from pure speculation, which is always going to be a good thing. It's a good precursor. It's important. I get you, but I'm excited more about that. And as an industry, very few people, I think, are focused on doing that.
I think Mike Novogratz actually mentioned and Tom Lee mentioned the concept of energy and energy bringing in investment. And I think that the casino did bring the energy. Like you got to give it the casino. The casino
But
brought
I
the
think the
energy.
casino is a side effect of the energy. It's not the cause of the energy.
Well, I think you were saying that there's no such thing as bad publicity in some senses. So it brings more people to focus their attention on crypto. So if maybe that's too cynical, but I mean that's helpful. But I'm 100% behind the point that these are lessons for us as an industry. And you take Binance, they're having to compensate people. That's a real cost to them, as well as the kind of maybe the few customers are put off and they join another exchange. And so they hopefully will fund internally, or maybe in a startup through Easy Labs or whatever, someone building something that might solve some of that problem for them, or an architect their
Customers.
Whatever, someone building something that might solve some of that problem for them, or an architect their
Customers.
I don't take some of that problem for them, or an architect their
Customers.
I don't take some of that problem for them, or an architect their
Customers.
I don't take them
if you're
and it's not like it's in the flow.
Customers. Watch a race car drive.
Binance does that stuff too. Very well.
No.
But that's not it.
I'm not disagreeing with you. I think it's an admission of guilt, and it was a clear market failure, and they're now admitting to that, and then say, yeah, like we were owning up to that, and we're.
But hopefully they're not just tactical about it, and they help us.
Well, look, it's also important to understand Binance is the biggest fintech company in the world. It's the biggest fintech and most valuable fintech company in the world. They're bigger than Stripe. They're bigger than all these other companies, right? They're bigger than PayPal, and it
is bigger than Stripe and PayPal.
And the thing to realize, like we talk so much about what's going on with stablecoins. The reality is that the most distribution of stablecoins happens through Binance Pay and Trust Wallet. De facto, that is how most stablecoins are distributed today. So Binance has their tentacles in almost every country in the world. By default, they're usually the dominant player in almost every market in emerging economies. Now, I think there's a lot of stuff that people can do better than them. But right now, we have to give it to them that they are a big part of why this industry is so big globally, outside the US.
Well, Tron to some extent too. Yeah.
Tron is the rails on which it runs,
Rails,
right?
well,
But it's like,
yeah.
it's their software.
All right, guys.
5 years from now, do you think that still's the case?
No, I don't
No,
think so.
Definitely not.
I agree now.
If,
Guys,
if we're here in 5 years and that doesn't happen, we've done something terrible as an industry.
I agree with that.
I agree.
I agree with that.
So I think now that we all agree, I think time's up. I think now we can maybe start talking about the actual topic, which is the blurring of the lines. Guys, thank you very much. We are completely out of time. Guys, thank you. Thank you.
Thank you, everybody.
Thanks, guys.
Yeah, that was great. Can we give it up one more time for our panelists? This next talk is also going to be about an intersection of crypto and public companies. It's on digital asset treasuries. So please welcome to the stage our very own Felix Jovan, Ben Foreman, Jeff Park, Seth Gins, and Christian Lopez. Give it up, guys.
Thank you.
20 minutes.
It's got fancy headphones. That's cool.
Felt the same.
Mic is on click.
Definitely should have worn a blazer.
All right, everybody. Thanks for joining us. And we are here for the Digital Asset Treasury State of the Union, otherwise known as the DATS State of the Union. Very excited to have an esteemed panel. I'll start with you, Ben, and just introduce yourself and just love to hear about what's your relevancy towards the DAT world.
Yeah, Ben Foreman, is my mic on?
Yeah.
Okay, great.
Yeah.
Ben Foreman, I'm the founder and managing partner of Parify Capital. We manage a little over $2 billion across public and private markets, all focused in crypto. We did our first DAT deal in January of this year, Sol Strategies, which is a Canadian-based issuer. Since we've done 25 to 30 different DAT deals, we've done pipes, converts, preferreds. We've also done deals outside of the US, so South Korea, Brazil, London, back Jeff on this in his new DAT, have done deals with Christian, have co-invested with Seth. So, you know, we've seen the good, the bad, and the ugly of the DAT world, and excited to talk about it.
Love it. Hi, everyone. My name is Jeff Park, and I am the CIO of ProCap, which is one of the Bitcoin treasury companies that will go online hopefully later this year if the SEC were to ever reopen, God willing. Before that, I was at Bitwise. I was the head of Alpha Strategies, and very happy to be here.
Hey, everybody. Christian Lopez. I am a managing director and head of digital assets at Cohen & Company. Cohen is an investment bank, kind of full service, capital markets, M&A, strategic advisory. You know, a big focus of ours is the digital asset and crypto industry. We've done, you know, I think over a dozen DATs, led over a dozen DATs from an investment banking standpoint this year. Work with Jeff's team, work with these guys across as investors, as principals and sponsors. Seen every type of structure, from SPACs to RTOs to pipes into vehicles. And I think we understand, you know, the playbook that works and what doesn't. But it's been a whirlwind so far. But yeah, that's me.
Hey, Seth Gins, managing partner at Coin Fund. I run our liquid fund, friends with everyone on stage here. Coin Fund, we have just under 2 billion AUM across venture and liquid. And on the liquid side, we have backgrounds in public equities. So I was a large cap growth investor for 18 years before coming full-time into crypto. So that's kind of made a lot of sense to our team. And we've been fairly prolific investors across the DAT space. So again, lots of perspectives on what's working, what's not, what the future looks like for DATs.
Amazing. So it's funny, at the last Digital Asset Summit, I also hosted a DAT panel. And at that time, this was, I believe, in March. So the meta was really just starting to get going. But that panel was a lot of just getting into some of the basics of it and getting people up to speed. But this time, I'm going to assume some knowledge from the audience and just really get into the nuts and bolts of that, because we are well into the meta now. So we at Blockworks have a digital asset treasury company dashboard there. And in preparation for this panel, I went in there and just wanted to start to count out, all right, so out of the amount of DATs that we cover, I calculated that 61% of them are now trading at a discount to MNAV. So with that as the context, I would love to just hear from you all of what does that say about where we're at in terms of this meta, and what are some of the implications from the industry? Anybody want to jump in? Just go for it.
Yeah, I'm happy to. I mean, I think we look at DATs as being individual investments, and there's actually a power law distribution on returns within the DAT space. And we can go into some of the details of this, but the trading volume that a DAT sees once it's liquid is a key component. And actually, before its registration goes effective as well, is a key component of the health of that DAT. And if you look in the ETH space, for instance, you have the largest DAT in Bitmine. The next largest is trading 1/10 of the volume of Bitmine. And then the next highest trading volume DAT after that is trading 1/10 of the second one. So a steep drop off in trading volume. The trading volume is important because that's what you sell your at the market facility into. That's where you issue primary shares, raise capital, and then you use that capital to buy the underlying token. So we've taken the view from the start that you're going to see differentiation, and you're seeing differentiation. A few big winners, and then a lot of DATs that will be very helpful for ecosystems, but we think of them more as ETF pluses rather than having a 10x type return from the pipe price.
Yeah.
Go ahead, Ben.
I would just add that I think like the state of the market can be just simply described with supply and demand. Simply put, there are just too many DATs and not enough demand to buy those DATs. There's no reason why you need like a 13th or 14th Ethereum DAT. There's not enough differentiation there. So what we saw is there are now roughly 200 DATs. Most of the top 20, 25 tokens have a DAT. You know, Bitcoin and ETH certainly, and Solana certainly have multiple DATs. And many of these DATs are now going through kind of a crucible moment where they're trading below NAV. There's not much differentiation. And they have to figure out, okay, what do you do? Do you sell your underlying digital asset and buy back stock? Do you issue converts to buy back your stock? Do you kind of do nothing and just kind of continue to, you know, to market your vehicle and educate investors? Do you start an operating business? But we're kind of at this weird point in the market where there was just too much supply that came online earlier this year. And now many of these DATs are figuring out kind of what comes next.
Yeah, agreed. I mean, I think I'll jump in, and you know, there's one aspect to this that I don't think people talk enough about is really it's a technical component, right? The flavor of DAT that has kind of emerged as the winner is, you know, pipe into an existing public company, typically like a micro cap that has 4 or 5 million shares outstanding, and you go issue a few $100 million in the form of a pipe. That's a lot of new shares. That's hundreds of millions potentially of new shares that are outstanding. And I think what some DATs did early on is really just allow all those shares to register simultaneously. And these things take, you know, 45, 60 plus days for the SEC to go through its review process, potentially have any comments, and then those shares all register. And, you know, you kind of have, you know, especially if they're trading at a strong premium to MNAV, investors all racing for the exits at the same time, because not all, but many investors are really here for the trade, or at least want to take some money off the table because they see that high premium. And so when you have all those shares register at the same time, selling pressure into the market is going to drive it down until it finds that bid. And frankly, there's just not enough of that bid available, which I think is partially why some of those are trading below MNAV, at least for now. I think maybe some still, you know, you guys might know, but some pipe investors might still be in the trade. And anytime that there's increased liquidity, which is a really important aspect to it, and we could talk about that post like pipe execution. But until you find that, I think people will trade at or below, or maybe slightly above MNAV until you flush out all of the money that wants to rotate out and find that new investor base. But it's that technical aspect in the beginning that I think people are starting to fix, and BM&R and others, orbs, have done a great job of fixing by putting in a kind of a 50% lockup for 30 days post initial registration. Yeah.
there's a really interesting dynamic because we've been talking about pipes, but when you look at SPACs, we really haven't had de-SPACs yet within the DAT space. So I think there's a really interesting opportunity when the de-SPACs happen to actually see them trade above NAV, get trading volume, have more of a pristine, clean structure. It's a little TBD, but
Yeah, no, I completely agree. I think one of the optical challenges the space has experienced is that the capital formation process itself in a pipe transaction has asymmetric information. And so your most informed and willing participants are the ones that are actually locked up and unable to kind of communicate towards the investment activities they would like to conduct. And so not only with the low float element, but there's actually no good information that can come out of those who are behind the wall that is able to tell the story, right? And so when you have a dynamic where the stock goes up a bunch and there are retail investors getting involved in a period in which the price discovery is not being perfected by actual price discovery of intelligent market investors, there's a little bit of a problem. And I think to one extent, the SPAC structure, its blessing is at some level that it is anchored towards the de-SPAC needing to first happen for it to actually become a live trade in itself. And so in some sense, if you're not able to have the volatility of the stock at the level in which there's kind of a mania of the low float dynamic, then I think there's a benefit we can accrue on the back end of it later when the consummation does happen.
Yeah, I want to take Seth's characterization of this power law dynamic that looks like it's likely going to occur, and just would love to explore and hear how you're all thinking about what I think we can all agree, and we're kind of hinting at this idea of some sort of consolidation that is likely to occur. And I'd love to hear how you're all thinking about this. Do we just see the situation where, you know, you got MicroStrategy on the Bitcoin, you got BMNR for ETH, perhaps, you know, Forward for Solana, and you get these few winners for each asset, and they go forth and you know, through various ways potentially acquire some of these at a discount? That could be pretty accretive. Would love to just hear how are y'all thinking about what that process might look like. Go ahead, Ben.
Well, so one very you kind of framed it as like if a DAT is trading below 1x MNAV, let's say it's trading at 0.9, and someone comes along and does a stock for stock merger to acquire that company, that's effectively like buying the underlying digital asset at a 10% discount to what you could buy it at in the open market. So I think M&A starts to come into the fore when these things trade below 1x. That's if you're in, like, let's say that's if you're a Bitcoin DAT acquiring another Bitcoin DAT, it would make sense in that scenario. There's also kind of cross-asset, more hostile DAT M&A that I think we'll see play out, where if you're, you know, an Ethereum DAT, you acquire a Solana DAT, you sell all the Solana, and you rotate into ETH. So I think you'll start to see that game played as well. But so I think that's like the most logical way things consolidate. And I think like what will catalyze a lot of the consolidation is a lot of the a lot of the DAT sponsors are highly mercenary. Like this is like their second job, right? They did a DAT because like they saw it as like a way to quickly make money. Their shares are under a lockup, and like, you know, if they can just like hand off the vehicle to someone else, to the winner, I think they'll want to do that rather than running like an irrelevant like 7th, 8th, 9th largest DAT in a certain asset category.
Yeah, to Ben's point, I think we're already seeing signs of those happening. There was an announcement by Strive acquiring Semler Scientific in the news on a share per share deal. So it's already happening. I think, though, I have a slightly nuanced take as to kind of how many categories there will be per token asset. I say it in the sense that because these entities are ultimately led by operators, there is an element to path dependencies for each of these treasuries achieving different outcomes that serve different client or investor-based needs. And what I mean by that is when you buy Bitcoin, right, like you don't really need diversification beyond maybe counterparty because you care about the custodial relationship, but Bitcoin's Bitcoin. If you're trying to take different kinds of risks on top of that with a managerial level, then I do think there is some benefit to having different operating diversifications as well. Take, for example, right now there's preferred equity that strategy has issued, and people seem to really like it. And you may then want to have more of the kind of economic exposure, but maybe you don't want to just bet the horse on Sailor, right? Like that single key man risk might in itself be a detractor. So you do actually want to pref from another well-run DAT just from a diversification point alone. I think there's a real possibility that could happen, but to Ben's point, there's probably some scale velocity that you do need to escape, right? Being a public company is not cheap. And so there is actually a minimum market cap threshold that I think every DAT needs to accomplish to be able to afford the privilege of being a public company. But once you get past that, I think there is room to imagine there is some diversification benefits for the different strategies that might be pursued along the way.
Just I want to touch on Ben's point earlier. Consolidation will happen for sure, but I don't know how soon that's going to happen. I think it's going to take a little bit of a longer time. If you've been in the DAT world over the last several months, which all of us have been, and I'm sure many of you in the crowd have been, it's only been like 7-8 months of real DAT play. It's felt like a lifetime. I don't think a lot of us have slept very much over the last 8 months, so maybe it feels like 2-3 years. But the reality is we're still kind of early, and these deals are just starting to close. Like company management teams are just starting to get their footing and understanding what the public capital markets are like, and then thinking about how do I generate value. And I do think there's like a people element and like a pride element of these folks, the sponsor groups who have started DATs. They want to prove to the market that, hey, I can drive value for my investors. I don't want to trade. I don't want to just give up and trade at a like 0.8 MNAV without trying. I think it's too early. So it will happen, but it's going to be a lot harder to get M&A done in the space in the near term than I think people may believe it is.
I think one of the elements that we're finding is super important. So we say structure, which is basically the selection of the shell, again, going to the pipe structure, execution, and then the chairman. Those are the three key elements to kind of hit that flywheel. And I think like there's a real shortage, and the chairman is important because we're talking about these DATs really are creating a bridge between traditional finance and crypto. They really are leading traditional investors to learn more about what's happening in crypto, to understand what's happening at the underlying protocols. They need trading volume to be able to engage. What you were talking about, Jeff, on the pref side, it happens in common as well, right? If you have a DAT that's only trading a few hundred million a day and a buy side firm that has 10, 20 billion AUM, they might actually need multiple DATs in the same asset to be able to get to their full position. But the chairman is really important for helping on that education process, going out marketing to institutional investors to the buy side. And there's so few people right now that have that network, either a traditional sell-sider who has a network on the buy side and is bullish on crypto, or a former CEO or former CFO, again, who's made a lot of money for traditional buy-siders, has a great reputation and understands crypto and blockchain and is willing to put their reputation out there. It's a really small group of people, but the positive dynamic is that pool of potential chairmen, potential like spearheaders of that education process is only expanding on a month-by-month basis.
So I want to ask about one of the key considerations that comes up when these DATs gets released for a certain coin is one of the key considerations for the potential marginal buyer on the open market is, all right, so as this deal takes place, where are the tokens actually coming from? Are they raising a bunch of cash that they're going to go into the open market and buy the token? Are they going to do an OTC deal with the foundation? Where are those coins coming from? Are they coming from VCs that are locked in some sort of OTC transaction there as well, which might be good for just the lack of supply hitting the market later down the road, but maybe it's not creating that marginal increase on the open market. Would love to just hear about how do you think that right balance is between those three? Who wants to grab that one?
Well, I think the answer is like it's coming from all three of those categories. Now, like I think they each serve a different purpose. Like often, like when one of these DATs gets announced, or even before it gets announced, you start to see the spot token, the token behind the DAT run up in spot markets, almost like front running the purchase. you see also many of these DATs basically take locked investor tokens, receive those in kind, maybe at a slight discount to market prices. That helps them blend down kind of the MNAV for these pipe investors. I think, generally venture investors, think about it as like, look, they have a locked up asset that they can't sell. Maybe they're on like a 2-year lockup. They can put that into a DAT and effectively accelerate their lockup period, accelerate the liquidity profile on those tokens. So you've seen a lot of that dynamic. And then lastly, many of these deals, like bankers, and Christian could probably speak to this better than I could, but you kind of want to price the deal around 1x MNAV. And so oftentimes foundations who are highly incentivized to get DATs into the market are willing to offer tokens from their foundation at a big discount to market prices. The way they think about it is, look, these DATs are effectively permanent capital vehicles. They have very, very long time preference. They're never going to sell these tokens. So they don't underwrite to those tokens entering the market, but they're able to put them in at a big discount to kind of get these DATs from 0 to 1. In terms of what the right balance is between those three, I think it totally depends on the DAT itself and what asset they're buying. Obviously, for Bitcoin and ETH, there's no foundation that can sell discounted tokens. There are no locked tokens, but certainly for the longer tail of alts, that dynamic starts to come into the fore.
Well, where I've seen, yes, it's definitely a mix, and you're seeing investors come in with cash, investors come in with the underlying, and then foundations participate. Where I've seen the most successful outcomes, especially in the beginning, and frankly, it's been tougher, right? For the altcoins, they haven't performed as well as maybe the ETH or the BTC plays. But where I've seen the most success is, roughly about at least 50% of the investment comes in cash, and then the rest in kind, whether that's contribution from investors or the foundation. And I think it's because of that, almost like the reflexivity that occurs. You take the cash, you use it to go buy a token in the open market, which should drive the price of the token, increases the book value of the company, which should drive the share price. Of course, combined with the execution of having your chairman, having a good PR strategy afterwards, that creates the flywheel that I think few people have been able to perfect. But yeah.
So it's actually interesting. I think like a little adjacent to your question, Felix, but I think the pipe size gets priced in pretty efficiently.
Yeah.
Right. So like the market sees a data is coming that's 500 million. It's going to buy 500 million SOL or get it in one way or another. The market understands what that impact is, and you get that move pretty quickly into the launch. What doesn't get priced in is that flywheel. So if you're one of the DATs that's able to, and what do I mean by the flywheel again? I mean, trade at a premium to NAV and actually have trading volume so that you can actually monetize that premium. If you're able to get that flywheel, that's what's not priced in. That's what gives you the sustained move higher. That's what happened in ETH when you had SBET, BMNR, ETHZilla, all of those coming at once.
Jeff,
Yeah.
anything to add there?
I agree with everything everyone said. One thing I might add is the flywheel also has to be authentically organic. I think this is the part that sometimes crypto investors are hypersensitive to, right? They're really just very tuned to this mercenary nature that the crypto VC ecosystem can operate in, and they're conditioned a little to be skeptical. And so I remember at the very beginning of the due diligence process, people would ask about whether foundations would participate in these DATs or not. And initially, it started off as like a positive signal. I remember people were like, "Oh, okay, the foundations, that's a good thing. It's like they're king-making this particular vehicle." And then the meta changed over time. It was like, wait, so now the foundation is actually kind of doing mercenary things to the vehicle, to which who's subsidizing that activity, and do you then not want the foundation involved? And so people can't make up their minds. And I think this all goes back to this idea that people want to believe they invest in something with transparency as to knowing how that flywheel is made. So it's not just like the investors. There's other dynamics too, where outside of Bitcoin, where if it's a proof of stake operating system, there's things that can earn income by being a validator as part of the system. And there's affiliate dynamics there that people have raised questions about as to, well, who's running what and which left pocket is going to which right pocket. And then you see things with like asset management contracts where you see, wait, is the pipe investor then somehow being involved on the back end through an asset management contract of those treasury assets? And they're asking all the right questions. I actually think this is very important that investors know what they're doing ultimately with their own capital to support. But this all goes back to why I think, Seth, to your point, like the seasoned kind of operators behind it matter so much, right? This isn't just like an ETF where you buy the asset and it wraps in a cheap, transparent, cost-efficient structure. It's actually run by human beings.
That's right.
And human beings who are going to, for years, build value accrual mechanisms on top of it. And that litmus test of whether this is like a trustworthy endeavor or not is a hugely important one. And so that organic flywheel, I think, is what people are trying to understand as close as possible.
Yeah. So one of my goals with this panel is just to, we hear that we throw around the word DAT, and I think there's this misconception that people view that all as, there's 1 DAT, 2 DAT, 3 DAT. They're all the same, but they're not at all. There's actually a lot of different structures and variations of it. Seth, you mentioned earlier how the most established one these days that we landed on is this idea of a private placement or a pipe going into a public microcap. And one of the key criticisms there that has been talked about is just the lack of transparency around what those deals truly look like in terms of, all right, so we get these pipe deals and, the investment bank that underwrites it, they get their fee, but we don't really know, how long are they locked up for in those pipes and the like. And so I would just love to hear from you, Evolve. How do you think we can just elevate the transparency around those deals so that the average investor who's buying on the public market can get a better understanding of what does that supply-demand structure look like for these shares?
Yeah, I think there's a key element of transparency. Look, the equities markets have a lot more transparency than what we have in crypto markets to begin with. I would say, that said, you have to read the filings, and not many people read filings.
Or sometimes they read it and they actually totally misunderstand it.
That is
and then crypto Twitter, of course, has its own kind of feedback loop that's incredibly recursive.
I remember with the SBET S3, the way the S3 is presented, it shows all investors, a theoretical where all investors have sold. And crypto Twitter was running with that, saying everyone is selling out.
That's standard on any S3.
That's standard on
You're
the
registering
S3.
all
That's right.
shares for sale. Yeah.
So I think that transparency is there, but there's definitely an education process. This is a new approach to crypto assets, and the idea that you might not want to buy in at a big premium to NAV when the pipe investors are not liquid yet is something that people figure out as they go through the documentation or the filings, and as they invest in a few of these.
Yeah, I mean it's mostly all. I mean it's in there, right? It's in the footnotes. It's in the definitive documentation. A lot of it is in sometimes sophisticated legal language, and parsing through it isn't necessarily the easiest thing to do. But I think what folks have failed to do, especially more retail, is try to understand what that actual MNAV calculation is. They kind of buy on the hype. They see, the DAT's trading at, $30 when it was trading at $2 a share. And they're like, this is great. This is going to the moon. But the reality, what that says is it's probably trading at like a 20, 30 times MNAV. And that, fundamental analysis isn't really being done. So I don't know who needs to do this, but there's, Twitter personalities out there that I think could do a better job of educating the market.
I agree. And I would also add that, I actually think crypto is more transparent than, in many cases, than TradFi. I mean, if I want to know what's going on with Athena or Aave or any on-chain protocol, I have real-time, transparent, auditable, wallet by wallet, block by block on-chain data. The issue with these DATs that I find is, even with perfect disclosures, even if you do read all the footnotes, you could ask an analyst at Blockworks and an analyst at Masari what the MNAV is on, BMNR, and you get like two different answers. Maybe one of them is including undeployed cash in NAV. Maybe one of them is, including like RSUs or options. Maybe they're converting the options under like, treasury method or some other methods. They're different methodologies. And so it is very difficult for us. So we just internally tried, we built our own DAT dashboard, and we tried desperately to automate it. But the issue is like what these different DATs disclose can be quite different. And so it's really a manual for us, at least. Maybe there are people that are better at it, but it's very manual, bottoms up, in terms of understanding exactly what MNAV is at a specific point in time. Not to mention like the timing mismatches on ATMs and share counts. So I think more disclosure is needed. And the beauty of public markets to some extent is, teams can be more transparent. I think the best teams like we've seen, create public dashboards that are you can visit from their website that have more detailed granularity around, what they own.
The one thing I would say about that is I agree, but there are regulatory restrictions about what you can disclose. You have to, in some cases, you're going to have to wait until the Q or the quarterly filing to actually disclose what's been done over the past, quarter,
Right.
which makes it extremely difficult. And I think the other part that makes it difficult is because we're so early on, the kind of like the TradFi equity capital markets data sources don't account for crypto. Like on Bloomberg, you could only really see, if you're pulling from Bloomberg, for example, you only see the price of Bitcoin or crypto assets, but it doesn't pull like how many of the underlying tokens that somebody has. So I think there just needs to be more development in this market and integration between TradFi and crypto for that to actually happen. But I totally agree. It's difficult. Us as the bankers, we're structuring a lot of these deals. It's very manual.
Right.
I sympathize with this completely. And yet, at the same time, I think part of the problem is we treat this MNAV concept as if the starting point of a conversation as to understanding value, when in my opinion, actually, the MNAV is the output of something that will happen if you're actually able to deliver something worthwhile. And so part of this is we're starting by wanting to know the answer without realizing, well, how do we actually even get to the point where the MNAV means anything, whether it's a premium or a discount? In other words, strategy at some level, I think, set the tone for what an MNAV is because it was the first and the most scalable, successful model that has been emulated. But I don't think it's the only model that you can succeed by having MNAV premium by financial engineering on the liability stack alone, right? That's one version of it. But another very intuitive version, I think all of us in this room can understand, is if you're able to generate yield on your assets in a durable fashion that has long-term terminal value, that itself has a premium. That's literally just DCF 101. And so in that sense, if you're able to deploy some abilities for earnings power, then the MNAV premium will happen as the output of something that was worthwhile. And I think at this stage, when most of these companies are nascent and haven't been able to yet demonstrate the possibilities we're imagining here, the starting point of it being MNAV is a little bit challenging because it's the wrong kind of start. That's where we should end up. It's a privilege to trade at an MNAV premium, not something that you deserve at the very beginning to be able to go and engage in the financial engineering on the back end of it.
Jeff, that's a good segue into, I want to start exploring the future of where we go from here on out, and just trying to understand what are some of the methods to go about capital raising. And obviously we have the Michael Saylor strategy roadmap established, which is equity issuance and then convertible debts and now preferreds. And obviously that's one roadmap. But then, as you say, there's also these methods of, all right, well, let's go for a token that has an inherent staking associated with it. And what can we do there? Or, go with what the forward guys are doing, which is, all right, we're going to start to do some stuff actually on chain and DeFi and elevate that further. So I'd just love to hear how are all four of you thinking about where we go from here in terms of innovation, in terms of capital raising?
Yeah, I can kick it off. I think for ProCap, the way we're really thinking about it is we're trying to be like a modern permanent capital vehicle that happens to be denominated with Bitcoin as a unit of accounting and build a durable kind of business around it for the long haul. And it sounds really simple, but that's at the end, the execution engine that we're driving. And it starts at first generating yields on the assets, to which I think people deserve the chance to earn authentic growth of the asset on a per share basis. When you're able to generate true Bitcoin per share without actually engaging in financial engineering on the liability side, people will immediately understand, oh, I understand what this is. It's like an ETF that's just growing by itself to get more Bitcoin into the wrapper. And people will find value in that thing. And you know what? It's really hard to find yield on Bitcoin because Bitcoin is pristine collateral. So when people say, oh, Bitcoin yield's only 2%, 2% on something that is hard to earn because it's actually very valuable and scarce and not inflating is a big deal. So the other question is, if you're able to generate 7% on a DAT that is because it's different in its consensus mechanism, there's a real question there about like what is the value capture there versus something else that is actually scarce, right? And so if you're able to do that and generate return on those assets, then I think you'll have the chance to play with the NAV premium to engage in some financial engineering to increase operating leverage on the company. Strategy has 4 different pref shares out there. Strategy has been able to find different ways to build audiences around those instruments. But I think over time, there will be other people who will tinker it differently to see what works better in different circumstances or what features might not be useful. And I think you'll see some diversification on that side. And then, only then, if you perfect the return on assets and liabilities, then I think the true kind of core story is the return on equity, which is there a chance to actually grow your operating cash flow by running a business to which that cash flow can be reinvested to actually then buy more of Bitcoin or whatever that asset that you're acquiring. And I think that's kind of the roadmap in which there's levels to graduating to earn that privilege. But ultimately, the long-term state is to be a permanent capital vehicle for which the operating cash flow can help you accrue more of the unit of account.
I think it's a great point, and people have been kind of tinkering with this idea of Bitcoin Hathaway, where you go acquire cash flowing businesses that maybe don't have a lot of growth but are generating strong cash flows with even margins over a long time. And how do you return capital to investors? Is it through the form of dividends, share buybacks, or do you go reinvest it into a pristine capital like Bitcoin? I think there's some companies that are going to go that way and probably have to go that way, simply because at the current moment, most DATs do not have the liquidity profile to go do really interesting financial engineering in the form of different types of leverage like MicroStrategy. And the reason MicroStrategy was able to do these syndicated converts is because they were selling volatility. They were the only, they're really the only large DAT trading billions and billions of dollars of volume on, an asset that its underlying collateral was like an 80 vol at some point. I think it's come down over the last few months. But because you have that volatility, public market investors, convert investors could go long the convert. It's effectively a synthetic call option, and then they go short the stock in their delta hedge, and they play with that delta, right? That's how they earn their yield. But most DATs at this point don't have that type of volatility, don't have that depth in the equity capital markets. So they're going to have to find other ways to generate the yield. The proof of stake DATs have that inherent yield from staking and going and doing interesting things in DeFi. But the way that you find capital raising right now, it's like maybe one-way converts with one investor. It's a little bit more expensive, a little more structured, but generating that volume and liquidity should be like goal number one for these DATs, so that they find a strong shareholder base that starts trading the stock. And at the end of the day, having that liquidity is the most important piece.
I think to kind of approach the question from a different angle, I think we're probably in the very, very early phase of institutional interest in crypto. So I think the pool of traditional financial capital that's looking to invest in a Bitcoin vehicle, an ETH vehicle, or altcoin vehicles is a fraction of where it will be in 2 years, 3 years. That's going to be a big driver, I think, of valuations in the space, of trading volumes, of the opportunity set or decision tree around accreting NAV per share. So it is a secular growth segment of crypto, and we're in the third, fourth month of it.
Yeah.
Right.
Just to like level set. So MicroStrategy is going to be in every business school case study around capital structure and capital markets. They're the largest ATM issuer in the history of capital markets. They're the largest convert issuer in the US or globally today. I believe they're also the largest issuer of preferred equity instruments. Their options chain has like the same open interest as MicroStrategy. So they've tapped into something very, very special. They're also getting passive flows. So people that are buying, the NASDAQ 100 are buying MicroStrategy agnostic to what their NAV is, just because they're running rule-based funds. And then, indirectly, like as some of that capital is then going to buy Bitcoin. So MicroStrategy, though, is in a different camp, but I think like it's reflective of what the menu of different options there are to increase NAV per share. And look, and it's not exactly your question, but I think our thesis on the space on DATS overall is, look, I think like the easy money has kind of been made. Most of these pipe deals were kind of heads you win, tails you break even. But I think now going forward, to echo Jeff's point, I believe that the best DATs will be able to durably outperform the underlying asset by increasing, units of Bitcoin held per share of fully diluted common stock, or units of ETH held per fully diluted share of common stock. I think very few will, but the very high quality ones are capable of doing that. And so it's about identifying the right team and the right capital market strategy. And then I think you have something that can potentially, generate alpha.
Yeah. All right, 1 minute left here. Just
to that point, just quickly, I think there's a perception disconnect where there's a view that like you create a DAT and it's kind of like creating an ETF, right? And I think the rarity of the DATs that are going to have good businesses that can accrete that NAV per share, that's that power law dynamic. It really is 1 out of 10, 1 out of 100.
Yeah, and I think that's key. Where some people, obviously with the government shutdown right now, which is stopping a lot of the ETFs that were supposed to be launched quite soon. And yeah, it's a key distinction between the two of you have the DATs and then the ETFs as well. So I think that's key. All right, that's all the time we have, guys. Thank you so much for that. Great State of the Union.
Thank you.
Thanks
Thank
again.
you.
Yeah.
Thank you.
Let's do it. All right. Fresh off the DAT panel. Manager Rangel and Jeff with me here.
Yeah,
Straight off it.
That felt
How's
kind of
that? Yeah.
that kind of felt like you know that scene in Gladiator when Russell Crowe is like fighting for his life in the Coliseum, and he goes, "Are you not entertained?"
What was the spiciest? I didn't catch it. What was like the spiciest
Man,
takeaway?
I think generally it was pretty civil. If there was a spicy moment, I would say I try to here for the virtues of Bitcoin relative to altcoins as a way to imagine what the treasury landscape should be like.
As opposed to just OTC deals from foundations and VCs and stuff.
For token funds to dump their coins on retail in a different format.
Yeah, no, that was good. Yeah, it's fun. But yeah, here we are. Next session at DAS London. Good times. Jeff, obviously you are deep in the DAT world right now, but you're also very dialed into the derivatives world and all of that. So I'd love to just like get your post-mortem on the weekend. We had Avi Feldman on before this, so we were diving into a little bit of it, but I'd love to just hear your story of the events of the weekend and how you read from it.
Sure. Man, at a high level, I think it was, as a headline, another data point for why DeFi has some superior qualities relative to its centralized counterparts. But those higher qualities also come with certain trade-offs, and those trade-offs are happening at maybe the social level too, as to what their expectations should be to the user experience that investors and traders are hoping for. So taking a step back, I think it's really important for people to understand that the futures market, especially when you apply leverage to it, is a professional environment. It's not really one for, I think, your just kind of casual investor to knowingly come in without understanding all the nuances of how the margin engines work. And in particular to crypto, it has always been the problem as to why it's different from traditional prime brokerage is that the intra-dispersion of crypto assets are not vibrant enough to generally have a very well-functioning cross-margin experience. The traditional prime brokerage model works because you do expect there to be diversifications of different assets you own between equities and bonds and FX and rates, and therefore you can create something a little bit more holistic on a VAR model. But in crypto, we all know when things blow up, it like blows up spectacularly in unison in the same direction. And so there really isn't like a great way to kind of model for that. And then spread trading is also really challenging in crypto, right? Because the ability to kind of take different risks when the price oracle themselves may not be like actually communicating correctly in the way you expect spread tradings to work. That's like another room for disaster. So all to say, like, I think these perps markets are generally useful for investors to make trading positions, but you know, I'm always surprised by those who have like their full net worth in like a perps portfolio. Like you should definitely not do that. And perps are not also, in my opinion, meant to be like buy and hold positions by any definition. You know, I think it's one of the reasons why most of the derivatives world that we know in TradFi either have kind of duration embedded into the way their instruments expire, or they have kind of reset levels. At the same time, like the idea of like having financing that is so dynamic that is changing against you like every 4 hours is like literally showing you that you're not in control of your own destiny. So I think a lot of people learn their lessons. Hopefully it just means that everyone levels up and tries to do better next time. But I think, you know, just looking down deeper, like the way that auto liquidation works for these perps market like happened the way I think people should have wanted it to happen, and I think some folks are maybe not as happy about that in itself for the effect that it led.
Yeah, it was tumultuous, but in TradFi there's circuit breakers, and it's something no one thinks about. Market structure, pretty unsexy topic, particularly when things are fine, and then exposed on a Friday night, low liquidity, no one can get, you know, the banking rails are shut down. So it people forget that maybe these things aren't, you know, quite the institutional quality infrastructure that everybody likes to tout in the investment pitches.
I love that word institutional because I've heard other folks kind of point this out too, like, oh, hyperliquid is not institutional and prime time for institutional investors. And what I think though they really mean, and this is kind of I think what you're picking up on is like institution means guarantees. Like it means that you want to call somebody or you want to know there's a margin of safety or you want to be able to kind of have negotiating leverage and apply soft powers of like being a human. And that quality of institution is exactly what sometimes crypto is trying to fight against. And so, I always find it kind of like a little bit ironic when crypto investors talk about things not being institutional in the exact definition of what they're supposed to be in the way that it's been defined.
You can't. Yeah, the problem arises when you accept things to be that and ignore the there's margin of safety that's removed because they're not there. It's the same thing with the wallet address, where if you send a wire to the wrong thing, you get refunded. Wallet address doesn't work that way. So you, as a user of the product, have to incorporate better margins of safety that in times of high liquidity, people like to you forget about or ignore purposefully. And
100%. So, Jeff, where do you think we go from here? It feels like we just had a huge washout. We bounced back a little bit here, but what's your high level read from here on out?
Well, on one hand, I am disappointed by the amount of wealth destruction that just happened for pro-tail retail investors. And because so much of crypto euphoria is built on the back of these capital, I am a little worried about that kind of scorched earth dynamic. At the same time, it probably means there will be consolidation towards hopefully higher quality assets. And in that sense, Bitcoin, I think, does finally now have the chance to maybe front run alts in the ways that is historically not usually how bull runs happen. And I will take that as a win, because if more investors are able to kind of build wealth through the Bitcoin lane first and then diversify into alternative exposures, I think that's the right path rather than the reverse. So hopefully this also just means that we'll see more consolidated flows into what I think is the most topical asset today, being Bitcoin, because it's at the center of global macro that is so unique for 2025 that almost no other altcoins really have the narrative for. So on that sense, maybe it's a blessing in disguise that I'm bullish for Bitcoin.
Can we talk about your gig and how much we could go into that? But I would love to hear a personal update, what your day-to-day is looking like and how things are going.
Yeah. So ProCap is a Bitcoin treasury co, and we are in the process of getting our S4 effective. And we are hoping that as soon as the government reopens, that we can begin that process in earnest and get it through. So right now we're in a bit of a waiting period. But in that timeline, we accomplished getting our team together and getting the blocking and tackling readiness for when we are able to go live. And so it's been a lot of preparing and also just trying to share more education around what the opportunity set is for investors to understand what digital asset treasuries are relative to other crypto access vehicles that are available.
Are you guys differentiating? Can you get into that, or are you not allowed?
I think we will be able to talk about that as soon as the S4 goes effective.
All right, fair enough.
Don't want to put you on the spot, but what you can share. I just think it's topical because, I mean, you guys just did a panel with, DATs have become sort of like everything in crypto is a derivative of a derivative. Their product market fit is reached, and then a million derivatives pop off. Most of them fail, and then people are reminded why the original concept worked in the first place. And so I just think it's interesting. If you have a personal opinion outside ProCap, what the DAT lands, maybe you guys covered this, but what the DAT landscape looks like a year from now.
Sure.
Where, if it resembles your alt versus Bitcoin framework, I'd be curious.
Yeah, for sure. I believe year to date now there's close to $90 billion that have been raised to DATs, and that's across close to 200 vehicles, globally speaking. So there's a great amount of attention and coverage now in this space. On one hand, what I am excited about DATs as a meta is that because it's led by operators who are able to be more front-facing to tell the story of exactly what the digital asset play itself is. There's an education element here that I'm pretty excited about. So historically, these ETF issuers do go on an education campaign to help investors understand what Bitcoin is, Ethereum is, Solana is, and all that. But it's a little bit restricting about just the asset, because ultimately that's the pitch, right? You're going to buy Solana because you think Solana is interesting, but you don't get to really experience all the like value accrual mechanisms around the ecosystem of Solana from just hearing the ETF pitch. It's part of it, but it's not really holistic. I think that 6 months from now, a year from now, when you have DATs that are being led by executives who are actually touching the plumbing to earn these value accrual mechanisms, they're going to find ways to share these stories in a way that everyone can understand. So I think on a net, like that's good for crypto, because so much of it is onboarding new investors to touch and feel and smell all the different things that are available without necessarily being kind of unaware of what you're doing. And in that sense, it's a little bit more proactive than an ETF, because ETF is a passive holding vehicle, and with that you get to experience a little bit of that in greater detail. So I think that's pretty exciting. I think beyond that, people will start to just realize, you know, what the different outcomes that can happen even amongst like one single spot asset, and that divergence of outcomes will help people understand what is possible and what is not possible, what is value accruing, what is value destroying, and those kinds of things are all pretty helpful for investors to get their heads around.
I want to ask you a question, because you've been vocal around the DAT space for a long time, and understanding of the benefits and what it brings and the opportunity set, dating back, MicroStrategy a while back and stuff. What is your response if someone says, okay, an altcoin wrapped in a DAT is still, lipstick on a pig, whatever. Okay, that's an easy one to understand, and I think most people agree that it's another kind of scheme to dump on retail for the bag holder VC funds. What about when someone says, well, and I don't think you've always been just more of like a Bitcoin. It's nuance to all these things, but one of the things people say is, oh, the Bitcoiners just basically became, altcoin people by wrapping their Bitcoin in DATs and shilling that. So I want to know what a good, rebuttal is to that.
Yeah, I think that Bitcoin is such a fascinating network, because you truly get so many personalities involved, and even though we're all in the same cause, at times it really feels like we're not. And you see that with like the spam filter debate on op return. You see that with how people have division around core versus not, and these things that are not part of like the institutional conversations that are happening behind the scenes, for when Vanguard, for instance, is adopting Bitcoin as a possible solution for wealth advisory. And so I think these things are important, though, because in the end, I think most Bitcoiners understand the terminal sustainability, at least for Bitcoin, has to come from some fee generation outside of block subsidy in the long run. I don't think people agree what that timeline is. Maybe it's 2 years from now, maybe it's 10 years from now, but we all know deep down inside there has to be like a way to advance this conversation. And so I see the role of a Bitcoin treasury to be a steward in the space and being able to have these conversations intelligently and share the possibilities of capturing some of that value accrual in a professional way. So in that sense, the reason strategy is successful is not only because it's first, but also because it's the biggest. And there's benefits that come from being the biggest, which is coming from its volume, but also the ability to diversify the capital structure with different types of instruments. But we also know crypto is very scarce when it comes to alpha opportunity itself. And I think there's rooms for DATs that are like smaller or more nimbler that can therefore capture that alpha accrual, because they're just not nearly as big to consume the entire ecosystem, and actually deliver that opportunity to their shareholder much more efficiently. In other words, there's really not a way for strategy to go do things on chain to earn yield at their size. It's simply not possible, because Bitcoin DeFi is not that big. Also, strategy can't really go out there and engage in the lending market at its full size because they're going to be the whole market. So there are reasons why strategy is built the way it is, and it's a great conduit to institutionalize Bitcoin risk, but it's not the only way. And I think there is a lane for treasury companies to operate in a different fashion, where the idea is actually to just get more network activity, garner more interest, and build ecosystem partnerships to help people understand what the actual network that you're purchasing, in addition to the actual spot asset that you're holding.
Yeah, well said. On the show a lot, we've been talking about this whole debasement trade. Feels like everybody's talking about the debasement trade.
You mean the purification
Well,
trade?
that's what I was going to get into. You always have these awesome one-liners. But you had the radical portfolio theory, which was super good. But yeah, you've been calling the debasement trade the repurification trade. And I want to understand what that means and how you think about it versus what everybody's talking about the debasement trade these days.
Yeah, I mean, I think it's a little cheeky in essence, but the debasement trade itself makes it feel as if the unfolding is negative because we're eroding value in something that people expected otherwise to be durable. And there's some sense of like loss associated with the word debasement, whether it's a moral one or whether it's a financial one. And the way I see it is when you see gold and Bitcoin being the top two performing assets year to date, it's really a purification of the cancer of our financial system as it exists.
Yeah.
And in a way, it's shift the Overton window maybe a little bit to help people understand that this is a positive outcome. Because sometimes I think the debasement and kind of crypto and anarchy and all this stuff feels so negative, and it's hard to like truly like get people to be invested and interested in something when you're talking about like the world's going to end tomorrow.
Yeah.
But really, like, maybe this is all for a good thing, which is like we're actually really trying to understand what money is, how to store value, and rediscover like first principles basis of like what that should be, and moving away from like a fiat based understanding of like the financialized world as it is today.
I want to get there. I'm not. When you look at the 2 speed account, if you understand this well, you are. If
you're on the upper part of the K, not the downward part of the K.
You're on the purification, but you're still drinking the dirty water if you're not on the boat. I like how you phrase it. It's true. I mean, you're seeing. We talked about it on the last one where you don't normally see these safe haven outside the system assets rising in tandem with the system, aka stocks, S&P 500 assets at the same time, and it's showing how there's an alternative that people are bidding at the same time, and it's a new dynamic, really. Gold's move. I mean, Bitcoin, we all know, is a one in a centuries thing. Like it started this century and didn't exist, but gold's move this last 5 years for an asset that's existed since time it's a one in a handful thing. And I think that is what people are trying to explain and describe by the debasement trade, where it's just not something that really comes around in decades and decades and decades.
Mm-hmm.
And I think we as a crypto experienced group have a propensity to underestimate the time it takes for these to play out. And I know for me anyways, fighting biases that have been built earlier in the crypto years is a constant battle where you feel like you're late, but it's actually
early.
We haven't even started QE again yet.
Yeah.
Like it's like, geez, like there's a lot of wood to chop still.
Yeah, no, it's true. I was before I got here chatting with one of my son's classmates' parents, and they were telling me they actually have tons of physical gold in their apartment, and it was kind of amazing to hear like a non-crypto person talk about actually that being a part of their wealth preservation strategy. And I don't know if that story would have come up unless it was so topical to find yourself reading the Wall Street Journal, the Financial Times, and people are like normalizing the discussion. And I think that's generally a pretty healthy thing. That being said, like there's still probably a lot of education to be done on kind of what the long-term like reflexive effects of all those things can be and whether that's good or bad ultimately for society and kind of wealth distribution. I also found it hilarious. There was this Financial Times article, I don't know if you guys saw it, was an op-ed piece by like a former ECB director slash city head of like banking policy or whatever. And the headline was basically gold bubble should be monetized by central banks by selling.
I haven't seen that. No.
No, it was pretty
No.
hilarious
Yeah.
because that's the headline, and you're just reading it like, wait, like, tell me you don't know anything by telling me you don't know anything.
Yeah.
Like, why would the buyers be the sellers,
Yeah.
the creator of the bubble?
Yeah,
Like,
yeah, 100%. Well, that's what I'm curious about you both think, because this idea of debasement isn't actually new. Like fiat currencies have been going downward, down only slope for decades now. Obviously, we had the QE decade of 2010 to 2021, but I'm curious how you both think about what's different this time, because obviously during that time we didn't have gold running like it is right now. Is it just that every fiat currency, and then even if you look at the Dixie, right, like it's been flat for quite a few months now, but gold is surging. So it's like, where do you guys characterize and figure out where the canary in the coal mine is within all of that? Because it feels like something's different in the last year.
Yeah, the pace.
Yeah.
The U.S. deficit chart is not normally like
Yeah.
we're 7% for 4 years running in a boom economy, and that's the other thing. We do not comprehend how problematic that is for the currency.
Yeah.
That is we talked about this, but I think Jeff, you'd probably agree. The nothing ever happens meme and mantra is pervasive in all of life and society now, but it's a factor of central bank intervention. That's why, because shit happens all the time. Like our president almost died before he, and we forgot about it.
Yeah.
But it's because there's a central bank globally that steps in and fixes everything. So it never becomes a market event that used to be clearing. There's a reason you have controlled burns and so stuff does happen. It gets papered over and every single time. And what I just don't think we comprehend it. And I literally write about this every day to try and cement it in my head every week about these numbers. NVIDIA is 4.5 trillion market cap. That's 2 Bitcoin market caps.
Mm-hmm.
That thing can not fall more than 20% in a multi-month stretch without carnage in the U.S. economy, because we all know the economy is the market. AKA 4.5 trillion of market cap for one company that has 34,000 employees, needs to be supported in perpetuity on a nominal basis.
Yeah.
So real returns are probably going to be shit, but you're not going to see 4.5 go to 2. It's going to be 4.5 stays at 4, goes to 3 and 3.5 or 4 for 10 years. Effectively, wiggles. But the amount of liquidity that needs to be supplemented to enforce that outcome is massive.
Yeah.
And then when you look at gold, and 80% of it is locked or illiquid or held by non-sellers, etc. That's why you can see parabolas in gold. And then you look at Bitcoin, and it's 1/10 the size.
Yeah.
And there's this just baton handoff because these numbers are astronomical. We like 4.5 trillion in one company. That's one.
Yeah.
Then you have 3.5 at Apple, 3 at Meta. Like these numbers don't make sense, and it's a factor of we just can't comprehend the size of this debasement problem.
Yeah. No, and I would also say it's part of the grand bargain where you actually then have foreign investors come buy U.S. equities, right? And that's kind of the full completion of the circle, which is actually kind of, I think, how the whole like trap exists for America's benefits. But I think what we're all saying here is like what's changed really is this is definitely a war that's happening that we're not calling it a war, and war just has taken on a different form of things that isn't related to like human loss or deaths. It's actually just being done at a much more strategic level. So even when you think about China, not only just like buying all the gold, but like they just opened up like their stock options market for the first time for foreign investors to come in. Like they didn't do that out of charity. They've never wanted like investor flow to go, but now they do. They want foreign capital in because they know that's part of like how they're going to counterbalance the Nvidia problem. And then on top of that, you add like how these like eminent domain type activities are happening with foreign companies across the world. Like just today, the Netherlands announced that the Chinese ship company is being seized.
No longer a Chinese ship company.
Yeah, no longer. And The Hague was like, great. And like, you know, The Hague stands for peace, but that was definitely not a peace move. That's definitely like a wartime move. And so I think all of this is basically showing like the debasement is unstoppable, because if you know the greatest surplus holder is your enemy, then you're just going to debase the crap out of it. It's a race to who's going to debase as quickly as possible to inflict the most amount of damage. And so I think it's kind of written in like this is the path of like how they're engaging in warfare at this point.
Yeah, the thing that I find most interesting that, of course, no one really thinks about it too much because it's a once every couple 50, 70, 80 years thing, is the long-term chart correlation of U.S. equity multiple premiums to rest of world is effectively 1-to-1 correlated with the dollar strength relative to other currencies. And that's the crux here, where, like you said, it's an extreme benefit privilege of the dollar, but it's also somewhat a curse because you can't let that down slowly. And that's why it's written it's in the stone, because you can't let that down slowly. Therefore, you have to let it down in real negative and not nominal negative, and paves the way for this trade, the purification trade, to run for years, because this is a years and years long. It took 20 years to blow this bubble. It's gonna take, you can't undo it in real returns. Maybe 10, 15.
And that's what frustrates me about the discussion about, you know, you have one side, which is Elon being like, U.S. government is going to go bankrupt. And it's like, well, no, they can't go bankrupt. But then you have the MMT side of things, which is just like, well, you know, we can print as much currency as we want because we are the sole monopoly issuer of it. It's like, yeah, but the cost is inflation. The cost is social inequality. Like there is cost. So yes, we're not going to have a treasury auction failure, but we're going to have people in the streets rioting if this continues.
No, there's a huge social cost. I think it was actually Michael Howell who posted one of the most interesting stats I had never seen before, which was the correlation with gold price to
fertility rates.
Fertility rates.
It's insane.
So if there's one reason why we might not be able to call it a purification trade, is because then we're not going to have people left.
Household sizes are almost below 2 in the U.S. And that just fundamentally is a problem for population. He can't sustain the economic. That's what brings it down. I talked about it at the monetarium. You have household formation falling below 2 people per house. There's no, and then you have the AI technocrats that are like, oh, robots, and then you're like, okay, what world are we living in? It's funky. I try to stress to like our investors and people I talk to about markets how weird this time is, because it truly is. And you can always say that, and macro people are particularly prone to always say that. And it doesn't need to be a doomer thing, although it's sort of the I'm so bearish, I'm bullish thing. But these nuances of it's truly something you have to approach from not previous 10 years, 20 years.
Yeah.
And that's what throws people off, because they're like, how can you be so structurally bullish gold or Bitcoin? I even argue with older market participants who shit on gold. And they're like, dude, that's a like wartime safe haven, like everything's going to hell type, like, and I'm like, well, guy, it's the best performing asset for 3 years straight with no volatility. So it's like breaking down decades and still market mantras.
Yeah. I mean, one way, and this is a little bit fantastic to imagine, that this will all play out is if you believe that general human productivity is going to be kind of less proprietary with the rise of AI, and everyone's kind of becoming a little bit more flatlined in their ability to contribute, then the national champions of your countries, like the Nvidias of the world, becoming so big where they're kind of like also not just a private company, but a public like government that can subsidize the population for like different dividends, it's a weird concept because America doesn't operate this way, right? We don't think of Amazon as like a government like or public good. Really, it's a private enterprise. But if you look at kind of other models, especially like in Asia and China, definitely, but also in Korea, where the private enterprises can play more of a public role as well to support society, you find different ways to like bastardize the concept of a market cap of a company. Like now it's not just the fact that it's 4 trillions of like any like revenue multiple or anything like that. It's actually just like what is like the value of the thing that distributes its goods to its people and becomes like almost like a public account.
You need the boomers out of power to actually effectuate that, though, because
Yeah.
right now it's
Yeah.
the one side where every time Nvidia's stock price falls 20%, we step in, print, benefit the shareholders,
Right.
And then
the
that drives the
employees,
economy higher.
and at the direct
Yeah.
unequal distribution. And so you need some, I don't know, a tax, or I guess Norway is similar, where you know everyone drives an electric vehicle in Norway, but they pump
They're
more
all
oil.
rich off oil.
I know, and it's like a cheeseburger's 30
Oh
bucks.
my God.
And it's like the funnest
Have you guys
price
have you guys ever been to Norway?
Yeah,
No, I haven't. No.
Have you been to Stavanger, their oil museum?
No.
Oh my gosh, dude, it's a kick. So you go there, and it's like where they also house a display for their sovereign wealth fund. It
Oh.
coexists in the same museum,
I mean, it
which is
should.
hilarious.
It's one-to-one
Um,
correlated.
But they also show this movie, and like my wife and I watched it kind of as a way to like just get into the museum. And it's like a 40-minute documentary about this guy who like basically is confessing his like moral guilt of like basically being Norwegian, because he like he just like has so much like angst about like not having to do anything. And it's kind of funny
The
because
society, you feel that when you're there in society. There's like a million art studios.
yeah, but he's also just like
Crazy.
angry in this whole
Yeah.
documentary. He's like, oh, he's like, you know, like I just like, and then he's like driving like, yeah, like
A BMW.
a BMW, and he's
120K,
complaining like, oh, life
It's
is
a weird
hard.
place, man. It's interesting, man.
That's wild.
It's,
Yeah.
well, I mean, they're sovereign wealth fund. They got the gig. They're loaded to the gills in Mag 7. At some point, you would think they start getting ahead of the train and moving
Yeah.
some of that to
And it's the
Bitcoin.
Swiss
because,
National Bank. They're in Mag 7 too.
Just Norway's
Yeah.
loaded to the gills in Mag
Yeah.
7.
Yeah.
And
Yeah.
you'd expect that to, I mean, but when you're that big in it, it's hard to
Yeah.
move.
Yeah. All right, guys. That's all the time we have. Jeff, awesome to have you on here. We're going to take a quick break for 15 minutes, and then we're going to have Jeff's old coworker, boss, Matt Hoogan. Was he your boss or coworker?
Yeah.
One of the two. But we're going to have Matt on after that. It should be fun. So, yeah, break for 15 minutes, and then we'll be back here. Thanks, Jeff.
Love it.
Enjoyed it.
Thanks for having me.
Thanks, brother.
Yeah.
Yeah, it's fun.
Thanks, man. Okay, here we are. Matt Hoogan.
Thank you
CEO Bitwise.
Yeah, I'm glad to be here. Thanks for having me.
Yeah, you're another one that I always try to catch at these conferences. We chatted at DAS New York last, I think, in March.
Yep.
And at that time was a really interesting one because we were talking about how all of crypto Twitter was super bearish at the time. And then just walking around the conference, all the institutions were just so fired up about stablecoins, ETFs, Bitcoin, everything. And that was mostly proven correct in terms of the direction. And yeah, here we are again.
Here we are again, and institutions are still just as fired up about Bitcoin, stablecoins, and tokenization. In fact, I'd say they're more fired up. We even have a term for the Bitcoin trade now on TradFi, the debasement trade. So it's been officially branded. That's sort of a stage of maturation. And then there's the stablecoin trade. But yeah, I would say the market for institutional demand of crypto is hotter than it's ever been. I think ETF flows are going to accelerate. I'm feeling pretty bullish.
Right on, right on. Yeah, I was reading your latest notes. You write a weekly newsletter, and you were saying that you thought, I think this year's ETF flows were going to surpass 2024, right?
That is right. Yep.
What's the thinking there?
Well, for one, I should say that's the norm in ETF land.
Right.
So I come from an ETF background, right? I was CEO of ETF.com before I joined Bitwise. Usually in ETFs, year 2 is bigger than year 1, year 3 is bigger than year 2, year 4 is bigger than year 3. That's for 2 reasons. One, big institutions take a time to okay ETFs.
Right.
So like in Bitcoin land, Morgan Stanley just said 2 weeks ago that their advisors could buy Bitcoin ETFs. So you have new markets that open up. And the second one, which is just so obvious, is like, what's the first time you bought Bitcoin? Have you bought Bitcoin since then? I bet the answer is yes. I bet you didn't just like one and done.
Yeah.
So even the people who bought Bitcoin ETFs last year are buying them again this year. Yeah, I really think flows are going to accelerate hard into the end of the year.
Is there anything particular about what we expect of a wave of altcoin ETFs that stands out to you as being, impactful to the market, aside from, broader access to these tokens, but, things that aren't being talked about and how important they will be for maybe market structure or flows or?
Yeah, probably 2 things. So from a flows perspective, the one thing I would point out is that there are some blockchains, protocols, assets that occupy a bigger space in people's minds than they do in a market cap perspective. So I'd talk about Solana, for instance. If you look at the coverage at Blockworks, the ratio of coverage between Bitcoin, ETH, and Solana is not that different. But from a market cap perspective, Solana is 1/5 the size of ETH and 1/25 the size of Bitcoin. Why does that matter? It matters because even a little bit of flows into Solana ETPs could significantly lift the market. So that's one thing I would keep in mind. From a market structure perspective, the thing that's happened in Bitcoin, as an example, is ETFs have become effectively a layer 2 for Bitcoin, right? There's a lot of trading and transaction in Bitcoin ETFs that doesn't manifest on chain. You can think of it as almost separating investment transactions from real world transactions. I suspect we're going to see that in these other places. And that's actually robust for the market. We don't necessarily want Solana consumed with investment related activity of SOL tokens. That's great if it happens on ETF land. So I think ETFs are very complementary from that perspective.
It doesn't inhibit the revenue potential fee profile, you don't think?
Well, it does a little bit, but I don't much care about that because I think people underestimate the size of the market that something like Ethereum or Solana is going after.
Right.
Those are enormous
relative
markets.
to today.
Yeah.
We always have a bias to forget how early it is.
It's so early. I mean, even people even do that just thinking about stablecoins versus tokenization. But just looking at stablecoins, right? The consensus is the market's going to 10 or 12x in the next 4 years. There's 1.8 quadrillion payments a year. Quadrillion. Like, how many times have you used that word? Never. So the size of that market is just so large that I don't mind if like me trading my SOL or ETH position takes place in ETFs. That's probably good.
Yeah. So I want to ask, that headline came forth, I think it was about a month ago, that went under the radar, which is just this change around the ETFs. Obviously, when they first came out, there's this idea of cash versus in kind. And correct me if I'm wrong, this is your world, but there was a change to that ruling, right? And what does that actually mean for that change?
Yeah. So cash versus in kind means how ETFs are created. Yeah. So for instance, under the way Bitcoin ETFs were first approved, it was called a cash creation. What that meant is effectively when an authorized participant wanted to create shares in my ETF, they would give us cash, and we would have to go out and buy Bitcoin. In an in-kind creation, they give us Bitcoin and we give them shares. The reason that matters in sort of phase one is it makes it easier and more liquid and lower cost to trade Bitcoin ETFs because it's just fewer steps and less slippage. So it makes it incrementally better. What eventually the world hopes for is that individuals could in kind and create. That's still a ways away, but just doing it on an institutional level makes the market more liquid. It's also just another signal that Bitcoin ETFs are treated like every other ETF. Right. So it's a normalization. That's how most of the market works. So it's a positive, but it's an incremental positive.
I don't want to go into Friday too much because it's just, I think it's a lot of noise. We've talked about it a lot. But from a traditional institutional allocator's perspective, does that interfere with, there's the narrative with this wave of potential altcoin ETFs, and does that interrupt either approval or excitement at all around those?
I don't think so. I mean, first, it's worth noting from a price perspective, Friday didn't happen to institutions. Right. The market closed at 117 Bitcoin and opened at 115. No big deal. From a excitement perspective, look, I'm of the perspective that that crypto broadly passed the stress test on Friday. I know there were some issues on Binance. I know there were some issues on transactions being fulfilled, but broadly speaking, it passed. So I don't think it dulls excitement. We're also in ETF land. While we're going to get a lot of ETFs, we're not talking about the long tail. Right. So, Atom traded to zero. There's no plan for an Atom ETF. Right. So I think if anything, it was a pretty good stress test, and I think we passed pretty well.
Yeah, that makes sense.
To that point about this, there's this change to the SEC recently where they made it so. Again, this is just out of my world. So
no,
but this is why you're here. But there's this change to basically the guidelines from the SEC, right? So now they don't have to go through this long-winded approval process. It's just like, all right, you have a futures already. Okay, great. So then you can just list the ETF. Is that how it works, or what happened there with those changes?
Yeah. So the way it used to work is you had to go to the SEC and beg.
Right.
And in addition to begging, you had to prove that this ETF was not subject to manipulation, which is sort of proving a negative, which is very hard to do. It took 10 years in Bitcoin, a few years in ETH, and every single one had to go through this process. What they changed is they moved to what's called generic listing standards. Generic listing standards means if you fit a checkbox, then you can launch your ETF. And so, as you mentioned, if there's a futures contract that's been trading on a regulated exchange, including exchanges like Coinbase or Binomial for 6 months, then you're good to go, right? And that means we're going to get a dozen crypto assets roughly launched now, and then more futures will list, and we'll get, a few dozen. A fun fact from ETF land is this actually happened in ETFs. So believe it or not, when ETFs were first created, you had to petition for every single ETF. And then there was something called the ETF rule, which was put in place, which established this generic listing process. What we saw is that the pace of launches in traditional ETFs rose by about 400%. So 4x.
Now everything's an ETF.
Now everything is an ETF. Yeah, that is exactly right. And so everything's going to be in crypto. We're going to see single assets. We're going to see index-based. We're going to see thematic. We're going to see levered. You're going to see all of it come to market. Not all of those will attract attention or flows, but some of them will.
Why isn't there a basis trade ETF? I've wondered that. And when I want to know when basis trade ETF and when ETH BTC ETF.
Yeah, great question. So on the basis trade side, there are some ETFs that do like traditional regulated option overlay and style strategies. It's hard to get into using perps in an ETF structure because you have the regulated, unregulated is like the blood-brain barrier of crypto, and it's hard to cross that. So that will still be a while, but not forever. On when BTC ETH, I think that's going to happen. We have an index-based product that trades sort of like GBTC that we've positioned to turn into an ETF. We're waiting for approval of that. I think that's actually going to be the second biggest category in ETFs after Bitcoin. It's going to be Bitcoin, index, ETH, Solana, etc.
It's so useful then it opens up different strategies for asset allocators, market neutral, like long short.
100%. And it's also worth noting, most crypto investors have a very specific opinion about individual assets, and most TradFi investors, as I said on my panel here, don't know how to pronounce Solana.
Yeah.
Right. So they are going to be better served with a broad-based basket, an index basket. If you looked at my index, you would find an asset that you hate.
Yeah.
And therefore you'd be like, I'm not buying that. But if you're a TradFi investor, you don't know and you just want exposure. And so I think that'll be a dominant way that many people gain
Do you
exposure.
think that leads to reflexivity, where the high market caps just get higher market cap?
100%. I mean, you've seen
Passive
that
in stocks.
Yeah, it's exactly right. Like that's
Yeah.
the Mag 7 experience. And then when you get automatic investing through 401ks or 529s, you do see that. So I think there is going to be a on the run, off the run difference between these popular index products, and other people are launching them, not just Bitwise. But I do think it'll be a category defining difference and different valuation.
I've started. This is a separate topic, and we can revert to ETFs
Bring
if
it.
it's- But I'm starting to see more talk percolate through traditional derivatives people, just totally non-crypto parts of the financial markets around perps, and a lot of tunes changing as in some cases people are receptive, and others they're like, oh, finally the one good thing that crypto has brought to is this perp model, that 24/7 and the updated funding, refreshed funding rates, and so and it makes total sense also, like why it's blowing up in crypto, because it's easier than other derivatives.
That's right.
Options, and good luck teaching
delivery on
teaching good luck teaching random person to, and the sizing metrics of,
it's a nightmare.
of CME contracts, things like this. So what is the most advanced, where are you seeing this type of proliferation most advanced within traditional, of perpification of traditional markets?
Yeah, you're definitely seeing it. So you're
Yeah.
seeing like markets like CME start
Yeah.
to investigate it on S&P 500. I think it's two things colliding. So one, it's the innovation of perps, which I do think is a real financial innovation. And the second thing is you have a retailification of the options market,
Right.
which traditionally was an institutional market, which could handle those large contract volumes, which could handle, various Greeks that didn't need to be WYSIWYG, where what you see is what you get. But now we have retail investors really embracing, and you put those two together, I think you're going to see the perps market become a dominant way that people gain exposure to all assets. It's just a really nice, neat innovation. Yeah,
It's I like the New York market hours for it's good for mental
of
health
mind.
when you're active in the markets. So hopefully they keep that going.
I would say enjoy it while you
Yeah,
can.
exactly.
The world wants to be global,
Yeah.
24/7, 365. That's where I think we're going to go. I do think it's going to change market structure. One thing I'd note, it's hard not to talk about Friday. One thing I note about Friday is the Trump tweet came out at 5 p.m. That was 8 hours after China. The reason it came out at 5 p.m. is that's when you dump bad news on the market, so the market has time to digest it. But that's no longer going to be the case, right?
The thing now that we're talking about it, that actually just light bulb went off. You have, if you start perpifying all traditional, so S&P 500, all these things, you need banking rails at 6 p.m. on a Friday, and that's stable. Either Swift is on the blockchain, which we saw some announcements, whatever, but that's stablecoin.
That's stablecoins.
You basically need stablecoins for perps.
You do
of S&P, whatever.
You need stablecoins. You need a different structural relationship.
That's actually wow.
I think that's going to happen too. And you do see regulated exchanges looking to permission stablecoins or assets like BIDL as collateral, like as official collateral. And the 24/7, 365 market needs all the pieces of crypto to really operate. So
I
think
if
you'll get that.
The bull case for stablecoins, just our government's debt problem is enough to be a ginormous bull case. But then when you think of bringing on the tens of trillions in equities and gold commodities into perps that need settlement collateral, it's like.
And then it's all global brokerages. It's not like just like one exchange in the U.S. It's just like everything.
Yes, this is what I mean when I said that people are not optimistic enough about the scale of these markets that these things are going after.
That's actually wild.
The size, the distribution. These are just enormous markets, and making them 24/7 will make them bigger. There'll be more transaction activity. So I really, I think people underestimate.
We need the Men in Black thing to eliminate our being in cryptos.
All our negative biases.
Yeah,
that kept us to survive to this point.
Because everyone's like, it feels like you're in crypto, you're like crawling, just like you're like the boxer that's just gotten smoked a million times. and we had such a sea change just in 9 months in administration and adoption and everything. It's so hard to comprehend that magnitude. You're like on the front line, so you're telling the story, and people are like, "Oh, he's just the Uber bull," because but you're like, "No, I'm talking to these people who are their eyes are open, and they control." One of these guys press a button, and it's more money than all the crypto controls, and you're like,
that is exactly right. I mean, there's $110 trillion of global stocks.
Yeah.
That's like a very big number. Right?
I got to see the numbers on a piece of paper
that's
comprehend.
26 times bigger than the crypto market, right? It's orders of magnitude. I think people miss that.
Insane. Talking about this idea of these like exotic ETF structures, something I'm curious about is I'm a big fan of like what Simplify has been doing, where they've been taking basically, all these exotic derivatives that are basically needed in NISDA to trade them, stuff like 7-year swap options. And what they do is they just basically put that in an ETF wrapper and then be able to allow retail to have access to that. I'm curious, what do you think about that idea of taking these more exotic things that were only for people with ISDAs, and now we have it in an ETF wrapper? Is there any interest in there from Bitwise himself or the crypto industry? What's your read on that?
Yeah, so generally speaking, I'm a huge fan of it. I've been a huge fan of it in the equity market and the bond market. One way to think of ETFs is they let every investor invest like the largest institution in the world, right? That's a really cool thing about ETFs. I can buy the same Bitcoin ETF as Harvard's endowment. I think that's pretty cool. You can package these complex trades and make them available. The risk of it is you have to do a very good job explaining it. Right. The number of investors who don't understand that a 3x ETF can go down when the underlying market goes up over the course of a month. It's actually very simple math to explain it, but the number of people get it is challenging. So you need explanations, but if you can do it, it's fantastic. Like, why should institutions have access to that trade and not me? It doesn't seem right. Bitwise is definitely looking at it. We think there's a sequence that people get interested in it.
Right.
But I think things like those buffered ETFs and things, if you can explain them well, will eventually be a very big market.
We need an RFix or PFix for Bitcoin, just like constant, super long call.
I think you'll get that.
That's nice.
Once you unleash, I mean, the ETF innovation machine is a little bit like the crypto innovation machine. It will stretch as far as the market allows. And now that we can do these things, I think you'll see them happen pretty fast.
Do you think, like, obviously we're all excited and bullish and everything, but can you foresee any sort of potential tear? Obviously, like we just had Friday where it's like, all right, a bunch of retailers on perp dexes and they all got liquidated, and it's like, all right, well, now we're introducing covered call ETFs and things like that. Obviously for that it's somewhat safe for the average retail, but if you get into these things that are a bit more sophisticated, do you see any potential tailwinds start to emerge? And is the solve for that just better education, like you're saying?
So the risk is, from my perspective of complex ETFs, is that people buy them who don't understand them, and then they blow up, and then they sue the ETF issuers, and they look poorly upon the industry. That's been happening in ETFs for the last 20 years. There was a inverse volatility ETF, XIV, that famously went up.
The oil ones.
In 2020. Oil ones went negative, and the 3x negative financials ETF returned negative during the financial crisis, which blew people's minds. So that is the big risk. Is there any like reflexive risk into the market? I'm not sure. We're pretty good at levering up in crypto. I don't think ETFs are gonna. I don't think we need ETFs to do more of that.
Have helped the volatility structure of Bitcoin. Whereas everything else.
That's definitely right. And for what it's worth, like ETFs fail all the time. They close all the time. They don't raise assets. They don't get flows. I think if we launch like a dozen, even the first dozen, there are 2 or 3 assets that I would be surprised if got any flows. So that's normal. But the blow up risk is really you introduce a complex ETF. Do people understand it? That's really the risk.
That makes sense. What about the option space on ETFs? I feel like the last time we talked, we started to talk a little bit about it, and it's just sort of like, well, we'll see where that will take us. Obviously, they're all now in play. What's your read on the options landscape on ETFs?
Yeah. So just to be sure, do you mean the growth of options on ETFs, or do you mean sort of option income strategies that we've seen?
Oh, the
on
growth
things
of
like
options,
Misty?
like just having option chains on
Yeah.
ETFs, and it's like comparing that to people are trying to do like on-chain ETFs or like direct crypto exposure, but I was always pretty bearish on them just because the spreads were so horrendous versus something like, these classic Bitcoin ETFs where the liquidity is a lot better.
I mean, look, from one perspective, ETFs and option on ETFs are a bridge to our tokenized future and our decentralized future.
Right.
But that bridge is going to extend for 10 years.
Yeah.
So right now, I mean, there's more IBIT options than there are Bitcoin options on Deribit.
Yeah.
Right.
Yeah.
So it's it's like the old meme about who's the captain of the ship. That is now the ETF TradFi landscape.
Yeah.
Broadly speaking, it's just good.
Yeah.
Broadly speaking, it's a different set of investors, which should reduce volatility, reduce serial correlation risk, and I think that's generally true. There are exceptions to that. So one exception, one of the reasons I think Friday was as big as it was is that traditional investors now use Bitcoin to react to markets when traditional markets are closed. That wasn't true 2 years ago. And now I think everyone reaches for that Bitcoin button. So that's an example of like the negative externalities. But broadly speaking, it's a net good.
Yeah, and I enjoy the safety infrastructure, integrity of traditional brokers. I think crypto space has graduated, but still, I think most people prefer custody in existing players, and also the liquidity and things of IBIT options. But what's the timing, do you think, towards like that? The 24/7 is the biggest, but traditional guys don't care, I guess. But it is that's a downside.
Yeah. So there are two forces to keep in mind. One is when regulation unleashes real 24/7 markets in a tokenized fashion in a way that most of the money cares about.
Right.
So I would guess that that's like a 3 to 5 year thing. I don't think it's tomorrow. And the second is, when do young crypto native people have money? Because every generation gets its version of a broker. There's the Charles Schwab generation, and then there was the E-Trade generation, and now there's the Robinhood generation. And you can see that Robinhood now really matters because the people who grew up with Robinhood now have actual wealth. I think the thing behind Robinhood is sort of a crypto native generation. I think that'll be the first generation that makes tokenized stocks. But those people, it'll take them 10 years to have real money. So I think it's coming, and there are probably these two phases, but it's not tomorrow. I'm very excited about it, but it's not tomorrow.
Yeah. Anything novel when you talk to these institutions in terms of the next 12 months of what they're excited? Obviously, there's stablecoins, Bitcoin they're sold on. Anything else there that's super interesting that you've been hearing?
Well, so first I would say their interest in stablecoins is just off the charts.
It's just insane. Yeah.
It's off the charts.
Yeah.
It's equal to or more than their interest in Bitcoin. And they love to find out how to invest in it. It's the first question I get.
Yeah.
So that's the big. The second thing I'd say about that group that maybe is non-obvious is the amount they're willing to invest is now significantly higher.
Yeah.
So to put data on that, for the first 7 years I was at Bitwise, the only thing you could talk about in polite company was a 1% allocation. Morgan Stanley just put out a paper saying go up to 4.
Wow.
Right. Which is 4x.
Yeah.
I mean, that's a lot more, right? That's a lot more. And we, in our own research, we used to show 1 to 5.
Yeah.
Now we show 1 to 10. Why do we show 1 to 10? Because an increasing number of people talk to us about having a 10% allocation. So they're expanding out. In terms of where they're investing beyond Bitcoin, ETH, Sol, tokenization, that's sort of where it ends. They're also very interested in crypto equities. I think Circle's IPO put that on people's minds, but they're really just in this two-story, Bitcoin and tokenization.
Is Vanguard talking to you guys yet?
I've emailed my guys at Vanguard. They'll come along.
Yeah.
They're gonna have to.
Look, Vanguard initially hated ETFs.
Yeah.
They said ETFs were like giving candy to an infant. And
now
retail,
they're like the biggest
and now they're the biggest player in the world.
Yeah.
So I almost don't want to say this because I don't mean it seriously, but there's a world where we wake up and they're one of the biggest players in crypto. They're one of the largest holders of MicroStrategy in the world. They're a very big dog, but they're coming along.
For sure.
Everyone, we should forgive people who are anti because they all convert, right? You can find Michael Saylor tweets where he hates Bitcoin. You can find Larry Fink talking negatively about Bitcoin. Eventually, even Jamie Dimon will say good things about the market. You can see him coming along. So Vanguard will get here. We'll get there.
Yeah, for sure.
Welcome. Yeah.
Welcome.
With open arms.
Welcome them with open arms, right? And there's nothing like the zeal of the converted. Just look at BlackRock.
Oh yeah, 100%. So yeah, you're hearing that allocation size is increasing. You're saying 4%.
Yeah,
is that sort of common where they're all going
I think
higher?
5%.
Yeah.
Oh, they're all going higher.
Yeah.
Yeah, 1% is rarely talked about now.
Right.
I think 3 is probably the median, and 5 is completely.
When do you think they'll get to like 100% 3x levered?
That's true.
Yeah.
That's true. Probably by December. Yeah. They will. They will get there. They will get there. But it's really changed. It's really changed dramatically. And I think one reason is volatility has come down. As volatility comes down, mathematically it goes up. The other is that the binary risk. The reason it was 1% for so long was that there was a risk that crypto didn't work, and then it would go to zero, and they would
your capital.
and they would get fired. I think that binary risk has disappeared from their minds.
Yeah.
And so now it's like, well, we're doing it. Let's do it at 5.
Yeah. Is there much interest for like a debasement ETF that's like 60% gold, 40% Bitcoin?
Yes, there's a lot of interest. So we have a gold Bitcoin ETF in Europe.
Oh yeah.
We filed about, but can't talk beyond the filing. Doing a debasement ETP in the U.S.
Nice.
I think it's worth noting, if you're interested in hard assets and you're 100% gold, you're off the market, right? The market is saying it's 90-10. 90-10 would be the base. If you're at zero, if you're 100% gold, 0% Bitcoin, you're effectively short Bitcoin against the benchmark of what the globe is telling you is global stores of value. So I think there's a lot of interest in at least being on benchmark. 60-40 is better than 90-10, but 100-0 is like mathematically wrong.
Yeah.
There's a lot of good some people put out about how important gold is to an equity portfolio, and how even 50-50, particularly the last few years, cuts fallen like a third, and your returns have been the same / slightly better, and with more optionality when you have smaller drawdowns.
60 gold, 40 Bitcoin has like a higher, I think, risk adjusted return or something than
very well could.
Just on their own.
But even Bitcoin's fall coming now, like barely even creeping above 40-45 is like that's less than most large cap equity.
Yeah, it's gotten down to that level. It's really been remarkable.
It's crazy.
Yeah.
MicroStrategy itself is 45.
Yeah. And the response to that again is a bigger allocation size. And so there's almost a reflexive loop there, which I think is important. Yeah.
We don't appreciate the mathematical reasons for why these things how much it's like how much of the equity world flows and moves off systematics and vol control and passive and exposure levels there, and how that also applies to adopting these new asset classes and lower volatility, higher growth. It's mathematically there's
they have to.
You don't need, we're always trying to paint this qualitative, beautiful mosaic of why adoption's, going to keep going like this. And, they have to, and because the governments and because and there's some more simple just math.
Yeah. They put it into a program and it spits out a number. And today that number is higher than it was 2 years ago. So they invest more. It's actually an important point. To that point, we published our first piece giving long-term capital market assumptions on Bitcoin to provide forecasts of what those numbers are. Before this year, no one asked us for it. So they're just starting to plug it in. And when they plug it in, it tells them they should own some Bitcoin, right? And so they're going to.
Boom.
Yeah.
Anything else you're excited about that we didn't cover?
What am I excited about? I am really excited. I'm really excited about the broadening of the ETF landscape. Because crypto tells a much better story when you're talking about all the things it can do. than if you're just talking about Bitcoin. And I think that's really changed. I'm excited about the downstream. I've been thinking a lot about what the second order investments are to like the stablecoin boom. I think many people want to invest in stablecoins, and so they buy ETH and Solana and Tron and Circle.
Yeah.
But I think if you have an enormous growth in stablecoins, you're going to see an enormous growth in DeFi. I think there's some interesting second order effects to stablecoin growth that people probably aren't paying attention to yet. So I'm excited about that. But mostly, I don't know. I think it's never been a better time to invest in crypto. So I'm just excited to watch the market grow. Yeah.
I love it. All right. Nat, always good to have you on.
Thanks for having me.
Yeah, love it.
Appreciate it.
Yep.
Yeah. Great chatting.
Thanks.
Cool. You all good? All right, so that's a wrap on day one, Digital Asset Summit. Hope everybody enjoyed the Forward Guidance live stream takeover. It's interesting, I was preparing for this live stream and obviously this conference and everything, and then all my agenda notes just got thrown out the window when the Friday crash happened. So it's kind of been the theme of the day here so far, is just sort of everybody reconciling what happened. But I think we did some good progress, had some good conversations. So that'll be us wrapping up here from day one. So tomorrow will be the OX Research podcast will be taking over. So if you're interested in hearing from Boccaccio, the host over there, we'll be doing the whole day two live stream there. I know he's got Paul from Plasma. I know Guy from Athena. I think Sid from Maple also. So a pretty stacked lineup of interviews there. So keep an eye out for that. Should be a ton of fun. And then on the last day, we'll also be having the Bell Curve live stream. So there'll be some interviews there. So yeah, we'll be returning tomorrow. Same time, 1 p.m. here, London time, whatever that is for your time zone. So yeah, thanks everybody for joining. That was a ton of fun.